It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
Live on Bloomberg TV and radio, counting down to another Fed rate decision and Chairman Powell news conference. Alongside Tom Keene and Katie Lyons, I'm Jonathan Farrell. Equities positive on the S&P 500, up by more than 1% going into this one, TK. The chairman, 1 hour away.
Up big. There's some momentum to the market here. You can look at it any way you want. I'll look to the VIX. I don't think Chairman Powell's looking at the VIX. He's looking at, John, what not to say, and also some sensitive topics to be addressed.
And then we've got to get to the forecast, Tom. We've got to deal with the statement before we hear from the chairman. Will those forecasts complicate the communication effort of the Federal Reserve chairman in that news conference? TK, we've got to go straight to number one. The dots. Well,
the dots are there, and you know it gets me riled up. We're 29 seconds into this, and you're mentioning the dots. We used to have an outlier dot, Bullard. I don't know what the outliers are. I don't know what the topography is this time around.
Kelly Lyons, do those dots shift?
Well, if they move forward to bring that median first rate hike to 2022, John, and you get a Fed issuing some language around when it's going to start tapering, how then does the chairman in his news conference separate those two ideas of QE starting to get pulled back and a liftoff?
That right there is the big challenge. 30 minutes to go. This is the setup in the market. Cross-asset worldwide. Looking at the S&P 500 advancing. It's a nice lift off the back of 4 days of losses. On the S&P, we advanced 47 points, up by 1.08%. This is the setup for Treasuries. TK, we've been talking about it. 10-year yields are exactly where they were when Chairman Powell closed out that speech for Jackson Hole, Wyoming, in that virtual symposium, 131.
Fractionally in from where we were this morning, the real yield is under 1%, negative 1%, a lesser negative number. But there's real stasis in the bond market. John, I believe we had panic in the equity market, but I'm sorry, there's a lift today. John, why is there a lift in equities?
No panic on that screen. Do you want to talk about China already?
It
seems to be the relief story.
But that's one of the things that Chairman Powell is not going to speak about.
We can speak about it in the next hour on this program. Katie Lyons, euro dollar, 117.27. Totally unchanged.
Totally unchanged, and I'm still stuck on that 10-year yield in and around 130, John. Priya Misra says that this bond market is priced for the start of a taper, but not actually the process of tapering. We're going to talk to her in just a few moments as we drumbeat toward the Fed. We're also going to talk to former Fed Chairman Alan Blinder. He will be taking us up to that rate decision at 2 p.m. Eastern time. And then we're going to get some immediate reaction from Grant Thornton's Diane Swank and Morgan Stanley's Matt Hornback. And then finally, after the news conference, we'll break down everything that the chairman said, some post-Powell commentary from BlackRock's Jeffrey Rosenberg and JP Morgan's Michael Feroli. But first, we have to talk to our in-house expert, John.
The first reaction, Katie, as you know, comes from one man. It comes from Michael McKee, our economics editor, our international correspondent. Mike, what have we got to look for at the top of the hour?
Well, you notice, John, I'm wide awake this time. This is the first meeting in quite some time where there is actually a significant market impact possible, depending on what the Fed does. We're not expecting them to say that they are tapering on a specific date, but we are expecting them to suggest that maybe it is coming soon. First thing we'll look at is the statement. In December, they introduced the phrase substantial further progress into the lexicon, and they have been saying in meetings since that the economy is making progress toward the goals that they set out. The question now is, do they say they are almost all there? Do they say they have achieved it? Do they say anything in the statement that suggests that maybe tapering is on its way? That would keep the markets pretty happy because that's kind of what's priced in right now. Then we look at the economic projections and we look at their inflation numbers in particular. As you can see, the 2021 figures are much lower than where inflation is. They've missed with that. They're going to catch up. Do they go over those numbers significantly to accept the idea that inflation is going to be longer and stronger than they anticipated? And then what do they say about the out years, 22, 23, at 2.1%, 2.2%? Is that realistic given where we are right now? And then finally, you guys already talked about this. Your favorite, the dot plot. 7 people moved in June over to the 2022 pile, but they would need to get 3 more to have a firm view that there's going to be a rate increase in 2022. Maybe not there. We may see it in the 2023 dots. They may raise those as they price in more rate increases in 2023.
Mike, for those on Bloomberg Radio, the dots to watch look like the victorious play construction of the Denver Broncos over the weekend. I just want to, the bias was seen there, Michael.
Well,
McKay.
everybody can see the dots in their brains because they've been seared into our minds right now. And the final question, we get 2024 dots for the first time.
Oh, very good.
So those of you who are looking forward to that, but there are going to be 8 new members of the Fed possibly by 2024, so they may not mean a whole lot.
And all 8 of them probably read along the way, Michael, one of the editions of Alan Blinder's classic economics textbook, Now Writing with John Solo. Professor Blinder joins us celebrating the 14th edition of his truly important and classical textbook. He is, of course, the former vice chairman. Quickly here, Professor Blinder, and then we'll keep you to the decision. What theory in Ball Blinder Solo, what theory is this Fed following?
You know, some people think this is a bad name, but it's a Keynesian theory. The Fed has been following Keynesian theory, I don't want to say forever. There was a flirtation with monetarism a very long time ago. But, you know, without using the name, the Fed has been following Keynesian theory for a very long time. Look, what would have Keynes said in 2020 in a deep recession? Cut interest rates to the bone, which is exactly what they did immediately. He didn't know about QE and other stuff like that.
What's the difference, Professor, to what we're facing now compared to, say, the 1980s, the inflation discussion that we're witnessing at the moment, experiencing?
I think there's a difference and a commonality. The commonality is there was reason back then, but people weren't perceiving it, to think a lot of this was temporary. A lot of the surge was temporary because it was coming from food and energy shocks. People realized that slowly, and it did indeed happen. The difference is that the entire level was higher then. It was like a surge from 7% inflation up to 12% inflation. This surge is like from 1.5% inflation to 5% inflation. So the levels of inflation are entirely different.
Well, obviously, we're dealing with quite substantial inflation at the moment, Professor Blinder. If the Fed does not move today towards normalization of policy, will they be acting too late?
I'm hesitating, but I'm going to answer yes. But let me explain the yes. The new Fed policy stance, the style of doing policy, is not to act on forecasts of inflation, which have proven themselves to be wrong. And if I may use a wonkish term, the old Phillips curve has vanished from the face of the earth. And so they have said, this is not a mystery, they have said they're going to react to inflation when they see inflation. Now you might say, aren't they seeing inflation now? The answer is sort of, but as you know, Chairman Powell and many others on the Fed keep emphasizing the temporary nature of this inflation surge. If they see embedded inflation that's too high, then they will react. But they need to see it, and therefore, to your question, they'll be behind the curve.
Alan Blinder, this is a Fed struggling with the long term, the short term, and the British medium term of John Maynard Keynes. How does Alan Blinder treat the modern technology overlay of this economy that Chairman Powell's dealing with? Are we making the right choices as we look at the present technology and the future technology of America?
It's a good question. Nobody knows the answer. I'm relatively optimistic about the near-term future for technological progress. Maybe I'm being deluded by some pandemic-distorted numbers, and that's why I hesitate to make prognostications. But the recent productivity numbers have looked better than they have looked in some time. They were looking really bad, as you know, Tom. They're looking better now. What would that mean for the long term or the medium term? It would mean, if it's true, and we don't know if it's true, it would mean that the economy has more running room. The so-called speed limit to use a term that was popular some years ago, is higher than we thought. Now, I want to caution, we don't know that that's true, but you can be sure the Fed is watching that assiduously when it thinks long term.
Hey, Alan, looking forward to counting down to the decision with you. Alan Blinder will be sticking with us alongside Priya Misra of TD Securities to get our teeth into this bond market, TK, with 10-year yields at about 131.
Well, 131, the yields come in and they've been stable. They come in a little bit today, John, but I'm going to look at the breath of fresh air that's the equity market. Dow Jones Industrial Average up 380 points. That's a lot better for the chairman with the today's meeting. What if that meeting, John, had been 2 days ago?
Did you just quote the Dow?
I quoted the Dow. It's an afternoon thing, John.
Is that what we do in the
morning,
afternoon? It's the S&P.
You know,
and in the afternoon, it's the Dow.
Yeah, well, good morning, good morning. It's the afternoon.
Good afternoon. We are about 18 minutes away from a Fed decision from New York City. This is Bloomberg. Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Chair Powell.
Jerome Powell.
He's looking at an environment in which global growth is clearly decelerating.
It's going to be interesting, this meeting.
The focus in markets will simply be on the language and on the dot plot.
But most importantly, I think, will be the dot plot.
I'm looking at the summary of economic projections.
You might hear a hint of tapering, but that's about it.
The announcement for a taper is probably not going to come before November and December.
I do think they will give us an outline of how it's going to work.
Kind of a pre-announcement.
Chair Powell's gotten pretty adept at delivering a dovish press conference.
The attention of global markets on Chairman Powell. That news conference about 45 minutes away, that decision 15. This is the setup going into it. S&P 500 advancing up 44, up by a little more than 1%, bouncing back from a 4-day losing streak. It's a similar story on the Russell, a lift up 1.6%. On the Nasdaq at 125, advancing 0.9%. Important to realize this is not just about anticipating the Fed today. There's a China story in here as well. Evergrande, we'll touch on that as we work our way through the decision and into the news conference. Switch up the board and get to the bond market. This is what we look like on 2s, 10s and 30s, and I can tell you 10s have hardly done a thing since Chairman Powell spoke at that virtual Jackson Hole symposium. 130.91 is where we are at the moment. Tom, yields in a basis point on 10s, on 30s, 184. This bond market hasn't done much, TK, since we heard from the chairman about a month ago at the back end of August. What's changed in the yield curve? We've seen that spread between 2s, 10s, wide and wide and wide, and we got to spring. What happened? Came in. Tighter, flatter curve. Right now, Tom, just north of 100 basis points at 109. And this is the difficulty today. Any signal, I stress any signal, on QE and tapering, can they divorce that from any guidance on interest rates? And will the dot plot complicate that communication effort in the news conference. Tom, that is basically it, the big theme right now for this bond market going into this decision.
For those of you This is just breaking from our Stephen K. Dennis, and in my opinion, this is more important than just a breaking news. He's 65 years old. He's a farmer off the tundra of Montana, and John Tester has suggested Powell is his man. Why does this matter? Because in his last election, he barely won. He's a blue dog senator, a Senate Democrat from Montana. 50.33% of the vote is what he took. John Farrow, those are the kind of politicians that are going to say, keep Powell.
TK, compare and contrast with what we heard from Senator Pat Toomey in the past 24 hours, basically accusing the chairman of allowing the Fed to be somewhat politicized. He's tolerated it. He said the Fed has wandered into the social and cultural areas where the Fed does not belong. It's a pretty split Senate on this one, Tom. And the Democrats aren't on the same page either. We know that Senator Warren is unhappy about what he's done, or rather hasn't done, with regulation.
Well, I'm not going to say it's Days of Our Lives or General Hospital here. Maybe it's General Federal Reserve, but there is a soap opera nature to this, John, around investment. But as Senator Tester talks about the thing, and you know, in the press conference, Michael McKee is the one who's going to bring this up. John, why don't you bring in our next esteemed guest?
Let's get to Priya Misra, TD Securities Global Head of Rate Strategy. Priya, I won't ask you about the investment decisions of regional Fed presidents. I'll allow the journalists at the news conference to take care of that in about 42 minutes. Let's talk about this bond market. The potential, the prospect of a hawkish surprise in the dots. What are you looking for, Priya?
So we're actually not looking for this hawkish surprise, but I'm nervous. It doesn't take a lot of dots. It's 2 dots. 1 dot moving higher can absolutely move the 22 median higher, can move the 23 median higher, and this is the first time we'll be seeing 2024 hikes. The Fed could be penciling in 2 to 3 hikes. And here's what's odd. The market is pricing in less than 2 hikes. The market is pricing in an extremely shallow hiking cycle. And so if we hear from the Fed that this is a normal, well, I guess new normal hiking cycle of 50 to 75 basis points a year, that's going to look really hawkish. I think that the big problem in the bond market is that the Fed is contemplating the unwind. We're going to start talking about tapering, the process. But there are very big questions that are unanswered. Structural impact of COVID on the labor market, or productivity, or inflation. And so I think the market's worried about a policy mistake, that the Fed is, starts the exit, but the economy, the fundamentals and the long-term potential of the economy is not that strong. I think that's the tension, which is why the bond market's the yield curve's been flattening. Treasury rates are not rising, even though we're contemplating taper in the next couple of months. And that's, I think, what I'll be watching for in the press conference. How does Chair Powell finesse that exit with these big questions?
Well, Priya, make the distinction between announcing the start of a taper and actually doing the tapering and the reduction of bond purchases. What difference does that make to the bond market?
Sure. So, well, we have only one episode of tapering. And at that point, it was really the stock effect, what the Fed calls, academics call the stock effect, the announcement effect. When then Chair Bernanke mentioned tapering, the market had the taper tantrum. The Fed has done a brilliant job setting us up this time for the tapering without that reaction. But there's still the concept of flow. They're buying 80 billion of treasuries, 40 billion of mortgages per month. That's going to go down once they start tapering. And our thesis is that that process is not priced in. Now, it's going to be messy. It's non-linear. But at some point next year, the market's going to wake up and realize there's a lot of treasuries and mortgages that have to be bought by the private market. And that's when we do think interest rates will rise. I think that process of, I think the start November, December is priced in. It's really the process, the end point, the hiking cycle. I think the market has to get its head around that pricing.
Priya, I got 4 ways to go here, but just as one indication of the liquidity out there, overnight repo continues to advance out as many expect. Just what Chairman Powell says, given the true wall of liquidity that's out there.
So there's a ton of cash on the sidelines. You can see the RRP keeps going higher every day. I mean, the debt ceiling is adding to that because the Treasury keeps cutting bills. People are staying in the short end of the curve. And I think that limits how much front-end rates can rise. But if you've got the dots that are coming in suggesting the Fed's about to start hiking next year, it's going to be hard to.
TK, you can't handle this, can you?
No, I can't handle it, but even more important.
Tom, if the chairman doesn't like it either, why are they there? Why are we here talking about it today?
Okay, this is the question. Vice Chairman Blinder, please explain to all of us Why do we have the dots?
Well, it's a short story. The Fed was under pressure way back when and had a chairman then, Ben Bernanke, who believed in it, to be more open, to give more information about what the committee was thinking. And I couldn't agree with that more. As you know, I've been a hawk on transparency forever. They settled on these dots. I didn't like it when they first did it. I didn't think that was the right way to express the Fed's opinion. I thought incorrectly that journalists would start ferreting out the names that go with each dot. Not too much of that has happened. But what's happened recently, and you just heard an example, is this focus on the median, as if that's the only thing that matters.
Yeah.
Let me just say clearly, the FOMC does not act on the median voter. That is just not the way they make decisions. They act on the recommendation of the chairman, which they rarely go against. So whether or not Jay Powell is the median in the dot plots, he's the dot that matters.
Alan, do you think that's less true today compared to, say, Chair Greenspan back in your day?
A little less than Chair Greenspan, but that was extreme. I mean, in those days, you went against Greenspan at your peril. I did a couple of times. I didn't vote against him, but I spoke.
How did that work out, Alan, when you went against him?
Yeah, and, I was afraid someone was going to get thrown across the room and hit me in the head. Not by Greenspan. He's a calm person. So it's not that, quote, I used to call that autocratically collegial. That it was a collegial decision, but made by an autocrat. It's not quite that way now, but Chairman Powell is the first among equals by far.
Okay, but Alan Blinder, this is absolutely critical and goes back to Lawrence Meyer, a term at the Fed in all. Did we prosecute better monetary policy when the central bank was narrow, a la Greenspan, I don't talk about the dollar, or this complete cacophony today where we're asking Jerome Powell to take over 3 institutional, even 4 institutional positions? Which is a better world for America?
Without being an absolutist about this, because there are things that come up, I like the Fed sticking to its knitting. Jay Powell's favorite phrase is staying in its own lane. That's a perfectly fine phrasing of the same concept. A lot of people don't understand. You folks here do understand. The Fed is enormously powerful within its narrow sphere of influence. Outside its narrow sphere of influence, which is monetary policy and bank regulation, it has very little, if any, power to do anything. So, when people talk about the Fed doing this or that to some social goal, that's very nice, but other people should be doing those things, not the Fed.
Well, Priya, as Alan suggests, Chair Powell has tried to stay in his lane. Many times we've heard him speaking on Capitol Hill, trying not to comment on fiscal policy. But at the end of the day, the Fed does have to take that into account. And I'm wondering how you, as a bond strategist, thinks about the fiscal conversation, also the debt ceiling conversation happening in Washington right now.
Right. There's a lot going on right now. We have the shutdown risk next week, and then the debt ceiling a month from now. And then, of course, this longer term fiscal and, what exactly do we get? Do we get the bipartisan and the partisan? I think there's a supply, there's a growth, there's a fundamental component. But for the Fed specifically, and given these deadlines, I see it more as financial conditions. Do financial conditions tighten? 2011 was an extreme example of that, massive tightening in financial conditions into a debt ceiling deadline. We see something like that. I think we do see cross-asset implications for the Fed. I think they want to buy time. Because we don't expect an announcement today, I think this is less of a factor. But if we do have a big tightening in financial conditions, I think November taper does look like it might be too soon. We are calling for a December taper, but absolutely, I think there's a lot of cross currents on the fiscal front. Ultimately, we don't expect a shutdown, and we expect the debt ceiling to be averted, but it's going to be pretty messy because there's no obvious bipartisan way to get all of this done in the very short period of time that we have.
Priya, 4 minutes to go. What's the position in this market that you'd take, that you'd be comfortable with going into this one and going into the press conference afterwards?
It's tricky. I think going into the dots, because I'm worried, I am a little bit short duration in the very front end, particularly against the UK that's had a big repricing. Coming out of the meeting, that's where I feel very strongly that the Fed has a very high bar to hike. The market's going to test it and call the Fed's bluff again and again and push hikes sooner. And I would like to fade that. So I think owning the front end at some point will be very attractive, because I think the Fed can taper, but it'll take a while for them to hike. They want to see inclusive employment and an inflation overshoot. But I don't think that's the trade into the dots, because those dots are going to complicate the message. Tapering is going to be viewed as tightening if hiking is right after that tapering.
So walk me through the trade that captures that, Priya, just quickly. What is that? What would you be doing? Would you be looking for a steeper curve coming out of the news conference? Is that how you position? What would you do?
Exactly. Yes, it would be a steeper curve. It would be high inflation expectations. The front end gets more anchored. So coming out of the press conference, I think a steepener, given how much the curve is flattened and likely to flatten in the next 3 minutes or after the next 3 minutes, I would say a steepener should be a good trade.
We will work through this bond market with you, Priya. Priya Misra of TD, thank you. Alan Blinder, thank you to you as well, sir. This bond market priced as follows, TK. 10-year yields up a couple of basis points, to just south of 131.
Yeah, 131, that's where we are, and we're going to see. I mean, John, last time around, I'm sorry, there were some surprises to the statement, and we did see some tangible movement out of the press conference. Overlay that with discussions of proper investment by officials. Overlay with that a little bit of things going on with China. Yeah,
with you.
I mean, I'm sorry, this is not a snooze fest. What's important here, Carol emails, and thank you, Carol, so much for listening. And I mentioned Luke and Laura earlier in General Hospital, and she said, well, what's that about? And I said, Luke was a monetarist, Laura was a Keynesian. Laura's all over Brainerd taking over.
Thanks for clarifying that, Tom.
Yes, thank you.
That's super helpful. Kaylee, we need to get through the statement. We need to get through the dot plot. We got to get through the news conference as well.
Yeah, we do. And we need to get through Chairman Powell trying to walk that line. Does he try to dove if we get a hawkish surprise? How much can he describe a consensus on the FOMC that doesn't necessarily exist?
That's what's going to be really difficult, Tom, to go into that news conference and to try and reflect the consensus of a divided Fed, potentially a divided Fed today, I think it's really hard.
We're going to stop the show for 12 seconds. John, what's the difference between a dissent at the Bank of England and a dissent at the Federal Reserve?
Depends who makes the dissent, Tom, ultimately. And I know that's a bit of a cop-out, but it does.
Yes.
It does matter. It does matter, and we'll see. Do you think there could be a dissent? Is that what you're setting up here, Tom?
No, I do not think so. I just thought it makes for TV drama, and we need it right now.
We need to build up the drama. 45 seconds away. Let's build up the drama a little bit. Here's the price action going into this news conference a little bit later this afternoon, and the decision that comes up in 30 seconds. It was always going to happen,
bill in my cup, please.
I think I owe you more than that. We're up 1% on the S&P. Switch up the board and get to the bond market. This is the setup going into this Fed decision, going into that dot plot, going into that statement. Your bond market looks like this. Yields come in a couple of basis points to 130.40. On 10s, euro dollar 117.28, totally unchanged on the euro. The decision, seconds away, a statement, the dot plot, 30 minutes later, a news conference. Here's Mike McKee.
We've got the hint that the markets were waiting for, guys. In their statement, the Fed says a rate taper may soon be warranted. Here's the money quote. They talked about in December of 2020 the idea that they'd have to make substantial further progress towards their jobs and inflation goals. The quote says, since then, the economy has made progress toward these goals. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. No date on that, but the next meeting is November 3rd, so you can circle that on your calendar for right now. Dot plot. 9 members of the Open Market Committee now see a rate increase in 2022. There are 18 members. So it's an even money bet that you get a rate increase in 2022 at some point. And we'll see as the time goes on whether or not another person moves over in November. A majority see 3 increases in 2023. So we're looking at 1 increase in 2022, possibly, and 3 in 2023. Let's look at the economic data that they talked about. They are looking for a much faster rate of inflation. It was forecast to be 3.4% this year. In June, they now see PCE headline inflation of 4.2%. The core PCE was forecast to be 3%. They now see it as 3.7%. So significant upgrades there. Growth is knocked down from 7% to 5.9% this year. And the unemployment rate is raised from 4.5% to 4.8%. Next year's numbers are smaller. 2023 growth 3.8, 2023 2.5, unemployment 3.8% next year and 3.5% in 2023. So we get back to where we were before the pandemic in 2023. Inflation drops from 4.2% to 2.2% the next 2 years, and core inflation from 3.7 to 2.3 and 2.2. So the Fed sticking to that transitory view that they had. They say in their statement the only real change other than the taper sentence is that the sectors most adversely affected by the pandemic have improved in recent months, but the rise in COVID-19 cases has slowed their recovery. No forecast in that. They maintain the same statement on inflation, that inflation is elevated, largely reflecting transitory factors. I can tell you, Tom, the vote was unanimous, no dissents. One additional bit of news, they doubled the counterparty limit for reverse repos, the individual counterparty limit, to $160 billion effective tomorrow. Today, the reverse repo facility jumped to a record of $1.28 trillion. So they're accounting for more desire for more paper from the Fed.
Hey, Mike, there's a ton to get through here, so let's work through it together and start with the price action, shall we? In your equity market, we stay elevated on the S&P 500 by a little more than 1%. In the bond market, yields come in a little bit at the long end by about a basis point or two, but it's the spread between 5s and 30s that might get your attention, Tom. Briefly after that decision, dipping below 100 basis points, the flattest in a year. We have an even split on hiking interest rates in 22. The evolution of the language we expected on tapering, Tom, largely expected. And if you want to take your pick of the equity market right now, banks, the KBW Bank Index, session highs, the banks like what they hear this afternoon, Tom. You take away whatever signal you want from that.
Very quickly here to get back to Mike and his important analysis. The banks showing a good way. NASDAQ 100 goes a little less. John, what I would really point out is what you nail, which is the media looks at individual bond yields. The pros look at spreads, and we saw immediate flattening coming off the set of announcements. John, what I see here is nominal GDP out a year of 6% or so. That's a rough number as well. But even more so, what I see out here is a long-term view, which is wildly contained. This is a Fed not on the same page as the inflationistas.
We've been guided towards this, Tom. I don't think anyone's surprised by anything they see on a terminal screen right now. This is about the news conference in 25 minutes. And these moves in the bond market are so subtle. Down 2 basis points on 10s, just north of 130, basically where we were. It's just this little move at the front end. Just this little move, picking up the scent that maybe there's more of a discussion about making a move at some point in 22.
I'm going to watch the Dow back to 35,000 on SPX. Do we get back to 4,500? Maybe not. Kaylee, what do you observe out of a wall of headlines?
Well, it's that flatter curve. Priya Misra basically nailed it, guys. She said she expects a flatter curve out of this decision. She also talked about how the market was going to care about the pace of the hike. So it's not just about that median dot moving forward to 2022. It's what the expectation is for 2024 and 1.8%. That suggests that the Fed is just going to do it as they have done in previous cycles, that it's not going to be an accelerated hiking cycle this time around.
And the chairman gets his opportunity now, Tom, in the news conference to really try and divorce any guidance around QE with any signal about interest rates and really lay out the reaction function of this Federal Reserve. What would lead them to make the ultimate decision to pare back bond buying and what would lead them ultimately to make the bigger decision to raise interest rates.
I'd agree with that, but particularly go plural on a set of reaction functions. That's a good entree for Diane Swank out of Michigan Economics, Grant Thornton, chief economist. Diane, I want to talk to you about Michigan football. Our Damian Sassower was with 100,000 plus people over the weekend in Ann Arbor, but that's an economy getting back to business, getting back. The Fed talks about strength in the economy. Do you observe that?
Well, we do have ongoing strength. We have been hit back by the Delta variant. There's no question about that. We saw it in the employment numbers for August, and I think we're going to see some residual effects that are even larger on the Delta variant in September and October. We still have the lingering effects of Hurricane Ida. We know from Hurricane Katrina that those effects on employment hit us for 2 months, September and October, and this was more broad-based, Hurricane Ida, with the floods, of course, in the Northeast. So I think we do have some rough road ahead. That said, the Fed is, we're seeing a Fed that's getting more hawkish. Even though they didn't put a lot more rate hikes into 2024, they're not going to do that right now. I think what you're seeing is that move to step up rates, to compress rate increases. A full % in the course between 2022 and 2023 is a big move, actually, in rates, given where we are today with no rate increases and at zero rates. I also think it's important to look at the fact that if you average inflation since the start of the pandemic, you get above 2% now, which is why you have so many people putting those rate hikes in 2022.
Well, Diane, this is all predicated on substantial further progress. What happens if the pace of that progress decelerates in the coming months? Does November then become December?
Well, I think that is the biggest issue for the Fed, is that the bottom line was this whole project on intervening in financial markets in March of 2020 was to prevent the pandemic-induced recession from becoming a financial crisis and being amplified by a financial crisis. They did that effectively. They did the asset purchases. We are long past the need for that. However, unfortunately, the window of being long past the need may all of a sudden be narrowing with everything from the shenanigans, political shenanigans on the debt ceiling and lifting the debt ceiling, and on what's going on in China with the Evergrande account fund. That is something we still have yet to see what's going to happen, and I don't think financial markets have really taken fully in the fat tail risks that are out there. We've got a world where black swans are flocking, and we seem to keep seeing a financial market that's priced to perfection, and this is just such a smooth transition, and I fear that it might be a more rocky transition.
Diane, I'd like to get a second look with Mike McKee before he runs up to set up for the news conference and runs away. But just finally to you quickly on the news conference. You're tremendous at this, Diane. What's the big objective for Chairman Powell in that news conference from 2:30 Eastern Time?
He's going to have to be a dove among the hawks. He's going to have to be able to say, listen, we're willing to taper asset purchases. We think things have improved enough. Financial market conditions are great. Everything looks good, but not be so defiantly optimistic as he was in July. And I think that means that he has to acknowledge the high level of uncertainty that we face. And so he'll be toning it down and not committing to anything hardcore in terms of tapering, even though we're on the precipice of tapering. He needs an off-ramp, and he needs to lay out that there's a roadmap there with an off-ramp.
Diane, stay close. Mike McKee, you've had a second look. What do you see?
Well, I think the biggest thing is that they are acknowledging inflation is a problem, but at the same time suggesting they're going to go ahead and taper. So that the idea of tapering and tightening to control inflation are two different things, and I am sure we are going to hear Jay Powell make that point going forward.
Mike, you alluded earlier to changing of voting next year, November, December, and on into 2022. Is this Fed so split that the voting matters?
I don't think so, Tom, because the way the economy has developed the last couple of years, nobody really knows what's going to happen in a month or so, let alone in 2 or 3 years. I think you could throw the 2024 numbers out completely. And 2023, you can still see there's a big, wide dispersion there as they try to figure out what's going to happen. Nobody really knows. 2022 is interesting because it does suggest there's enough inflation pressure that enough of them are worried about that they could see a rate increase in 2022. The committee split 9-9, and we will see as new people come onto the committee in the next 6 months whether that changes or not. But it does suggest the possibility, if we don't see the inflation come back down, that they could start raising rates earlier than they had planned.
Well, there's the inflation side of the story, Mike. Then there's the growth side of the story. And looking at the economic projections, GDP for this year was revised down 5.9%, but they actually upped it slightly for next year. Just how much uncertainty on the growth front is this Federal Reserve dealing with, and how does the chairman approach it in the press conference?
Oh, they're dealing with a lot of uncertainty. We have seen growth slow down, and we didn't expect the growth slowdown that we got in the third quarter. According to the Atlanta Fed GDP numbers, it's around 3.6%, significantly less than the 7% or so people had penciled in for the third quarter. And so the fourth quarter remains a mystery. We don't know what's going to happen with COVID, so we don't know what's going to happen with consumer spending. And businesses are still struggling with supply chains, so we don't know what will happen with business spending. So they're really just taking a guess at this point, a sort of a best knowledge guess as to what's going to happen. With all of the indicators, they're still sticking to their belief that inflation will be transitory, though.
Michael McKee, good luck at this press conference. Hope you get a question more than the last question. Maybe he'll get the first question.
Well, second to last, Tom.
This time. Second to last would be an improvement as well. On radio and television, we welcome all of you worldwide. And John, I think you should set up a better equity market here and where we are. But far more, John, our next guest really has one of the toughest jobs on Wall Street. At Morgan Stanley, he has to herd the cats as head of global macro strategy.
Matt Hornback, Chief Cat Herder, is going to join us in a moment, Tom. Before we get to him, let me reset and get you to the price action. We are bid in the equity market. We were bid going into the decision. Right now, we're up about 50 points on the S&P. That bid sticks by a little more than 1%. There's a subtle shift in the bond market we can work through together. The front end biased higher, yields up just a little bit. The long end yields in just a little bit. 2 points to discuss. On QE and tapering QE, this is the line. A moderation in bond buying and the pace of bond buying, quote, may soon be warranted. On interest rates and the dot plot, this is the line right now. The forecast in that dot plot showing an even split on a 22 rate increase. Yep. There is just a flavour, a hawkish flavour to this decision, Tom. I don't think you can run away too much with it. We've got a news conference that's about 16, 17 minutes away.
Good afternoon, Francisco Blanche at Bank of America. John, I'm practicing my good afternoons right now.
I need to practice too, Tom.
Good afternoon because $100 oil right now, Brent crude $76 a barrel.
Good afternoon, good afternoon.
Yes.
The muscle memory of good morning is tough. Matt Hornback's with us now. Usually talks to us in the morning. Is with us in the afternoon of Morgan Stanley. The head of global macro strategy joins us right now. Matt, you ready to take, please, sir? What is it?
Well, first of all, John, I'd like to point out that I'm a dog person. I don't herd cats.
I'm with you. Matt, I'm with you, but I got in trouble the last time I did that, so avoid it at all costs. Carry on.
Indeed. Look, I think the main message to come out of the materials we have so far is that the inflation is starting to bother them. It's not yet a major concern, but it is starting to bother them. I think that's the takeaway that I have here. You've got core PCE above 2% throughout next year. Of course, most forecasters expect it to dip into the middle of the year, but to end the year above 2%, certainly moderately above 2%, but nevertheless above 2%, and not to have a rate hike on the books, I think ultimately what that means is they are going to be paying very close attention to inflation expectations and how they evolve. And what we've seen in the official data so far is that these inflation expectations continue to move higher. I would expect to hear some kind of commentary out of the chair at the press conference addressing this issue. And you better believe, John, just like they pivoted on tapering, they might pivot on rate hikes in 2022. The inflation numbers are the story today.
Well, Matt, as you say, the Fed seems to be getting more worried about inflation. I look at the bond market, though, and it doesn't seem worried about inflation. Frankly, it really hasn't since the end of March. Does sub 130 on a 10-year after this decision make sense?
Well, we don't think a sub 130 on the 10-year has made sense for several months now.
Fair enough.
I think we understand what is happening, right? This is a byproduct of the liquidity environment we've been living in since the Fed began to throw as much money as it could into the bond market, alongside other central banks, I might add, including, and importantly, the ECB. But yeah, this is essentially a byproduct of the liquidity environment, which the Fed just told us is soon going to be drawing to a close. So we need to keep our eyes on the prize here.
Matt, the only reason you're on is we figure an economist from Vassar probably knows the King's English. I'm looking at a Fed that's a two-adverb Fed. They're trying to finesse this. And the phrase I see is slightly hawkish. I mean, we're crushing language here to try to describe the unknown. Oh, Weiser from Vassar, should we be using adverbs to discuss this press conference?
Look, I don't think so, Tom. I think we need to understand that during this last hawkish move by the Fed,
hawkish, there it is.
Well, I remind you that 3 months ago, the Fed wasn't even willing to talk about tapering, let alone put a timeline on it. And today, they're not only talking about it, they're putting a timeline on it. That is 3 months earlier than anybody thought 3 months ago. So they've achieved this pivot. And why hasn't the bond market reacted? Is because we've just endured a growth slowdown and a variety of other walls of worry in which we are currently climbing. Once we get on the other side of those walls, Tom, the grass is going to look a lot greener on the other side. So I think the bond market will have a much more difficult time being so nonchalant when we move closer to rate hikes.
We've pushed this decision through the bond market. Let's just sit on the FX market a moment. TK, the dollar index, for all this talk of hawkishness, the dollar index is weaker.
Yeah,
it's above 93, but we're weaker by about 0.2%.
It's weaker, and within Hornbach's note from fractious Morgan Stanley, and I take that with great pride of their great research over the years, Matt Hornbach justify resilient dollar versus a consensus certitude of weak dollar.
Well, look, we've been bullish on the dollar for several months now. It's been a grind, there's no doubt. We continue to remain bullish on the dollar. You know, look, volatility in the currency markets has been abysmal. And when you get a 20-pip move, everybody starts to get concerned naturally. We think you have to be patient here. You have to keep your eyes looking ahead. There's going to be a rebound in growth, certainly in the United States.
Yeah.
Even globally, perhaps. Look at COVID cases. They are on their way down.
So, Matt, we're dancing around this. Let me put you on the spot. You going for a hike next year?
That's not the Morgan Stanley base case, John, but I think when you look at the marketplace, I think it will need to put more risk premium on a rate hike, you know, sometime in the latter part of 2022.
I like that, Matt. You see that, Tom? That's how you stay out of trouble with Ellen Zentner. You don't make the Ellen Zentner call for Ellen Zentner. You know, that's what Matt Hornbach was doing just then, TK.
Our theme today is soap operas, and the soap operas, Morgan Stanley does original research invented by Steve Roach, where everybody argues. And Hornbach's the one that's got to piece it together.
We'll keep Hornbach out of trouble. Dan Swong's still with us, I'm pleased to say. Dan, you've listened to that over the last 5 minutes. Matt Hornbach, I'm not going to say Matt said this, you've heard it. Leaning towards the idea, potentially maybe, of a hike next year. What say you?
I think it's a strong possibility, and Ellen's a great friend. And I have a forecast that's also in early 2023, right at the turn of the year. But listen, we've got 4 members coming on to rotating on in a voting membership way onto the Federal Reserve, who all are in that group of 9 of rate hikes in 2022. So I think that does matter. I think the composition of the Fed matters. Now, we've got a lot of uncertainty. Is Chair Powell going to be reappointed or not? What's going to happen is Randy Quarles is going to stay on as Fed governor. It looks like he will, but not be the vice chair of supervision. We've got some changes coming on the Fed, but there are a lot of Fed presidents who are sort of on the side of being much more hawkish. And that's why I think you've got to think of Chair Powell being the dove among the hawks. And I don't think this is slightly hawkish. I think this is actually hawkish because we're actually looking at the Fed, looking at inflation averaging and saying, listen, looking over the horizon, we got to raise rates in 2022. At least half of us believe that. That is something that is significantly more hawkish than they've been.
Does that mean, Diane, that rate hikes are not, in fact, divorced from a taper?
So Chair Powell will do his best to say they are absolutely decoupled from a taper. That said, if inflation, one of the things that struck me today was the CEA chair did a speech and talked about, when asked about what is going to happen to owners' equivalent rent component, the shelter component of the CPI, she said that their analysis suggested that every % increase in the Case-Shiller index translated into about 11 basis points in the owner's equivalent rent. That's a lot of residual inflation in the shelter component coming down the pike. And that's something that I think the Fed has not that's not the transitory stuff we're talking about. That's something that could be more lasting. And the Fed actually being in the position for the first time in decades of actually chasing instead of preempting inflation.
Diane, I'm going to go all Greenspan on you here. And I do it with immense respect for Chairman Greenspan and his core work on data analysis of his nation and your dogged work with NABE and what you've done in the Midwest over the years. Are we making a shift from a goods recovery over to a service sector recovery? Is that what the PhDs at the Fed are telling Chairman Powell?
Well, certainly that's what we were doing. And that was going on very well until we got this hiccup in August, which was more than a hiccup. The Delta devastation is really sort of stunning, thinking that we could have as many people die by the end of this year from COVID as we did during the 1918 pandemic.
Yes.
Now it's off a bigger base of population, but this is really devastating. And so I think it's really important to understand every time we see this sort of flare up of cases, we see the pullback exactly where you'd expect to see it. Not as much, but it still is there, that Delta is a factor where people pull back on spending indoors in indoor venues, and they start to spend more on goods again, but we can't get goods. And that causes this tension of shortages, all of the supply chain problems that we're seeing out there. And those problems are going to be much more lingering, I think, than the Fed has anticipated. And that's something, unless we see a major slowdown in global growth, which can't be ruled out as well, because we are seeing
Right.
the fact that we have a pandemic anywhere is a pandemic everywhere, and China's slowing. But barring that, you're going to have an inflation problem next year.
I think, Diane, of economists as different as the wonderful Lyle Gramley and Alan Meltzer of Carnegie Mellon. And the idea that their reading of history here is that this is always a Fed that will wait and wait and wait. Is what we're missing into this press conference is they're going to wait till 2023.
Well, that's certainly where Chairman Powell will say they're looking at it. But let's face it, they're split. We don't like to. He will do everything he can to derail the dreaded dot plots, because in some ways we know the dot plots have been really wrong. And face it, if growth slows a lot, we will derail some of these inflationary pressures, and the Fed will be further sidelined. So he really doesn't like the dot plots. That said, he's going to have to counter the fact that the Fed is now evenly split between 2022 and 2023, and some of them with more than one rate hike in 2022.
Matt Hornbach, I want to bring you back in here. Obviously, the chairman is going to face many questions in this press conference today. Part of them, I am sure, are going to be what's happening with China Evergrande. How do you think about the influence of what's happening in Chinese credit specifically, and how it reads through here to the U.S. and how the Fed is going to deal with it?
Well, I think that ultimately what the Fed's first priority will be is the outlook for the U.S. economy. Now, to the extent that disruptions in markets overseas end up causing financial conditions tightening in the U.S., which we saw a glimmer of on Monday of this week, that ultimately could end up weighing on their decision making. But we have to bear in mind that the state of financial conditions in this country is extraordinarily accommodative right now, and even a modest tightening, which it's even hard to call what happened on Monday modest. I mean, it was just so infinitesimal that it probably doesn't show up all that much on the radar screen at this point. We're just not even close to having that conversation yet, I think. So ultimately, the Fed needs to focus on the U.S. economy, focus on financial conditions being very accommodative now. And ultimately, the tapering process is meant to create an environment where financial conditions don't continue to ease as dramatically as they have been.
Obviously, there is a narrative now in the market that China is going to step in. Beijing will handle it. And there's a narrative down in Washington, D.C., that Congress ultimately is going to handle the debt ceiling. It's just a matter of time. We've done this song and dance before. If that isn't true, that creates, as you say, a problem for the U.S. economy in theory. We had a number of Treasury secretaries penning a letter about that earlier today. I'm just wondering how you think about that.
Well, I think that the Fed is going to wait and see what happens. And of course, they will be advocating for the government to raise the debt ceiling, as many others are. And I think ultimately, if it gets resolved in the way that it has historically, then it won't be that big of a deal. But of course, if it turns out somewhat differently than before and financial conditions tighten, the Fed will at least have to monitor the situation very closely, which is something that they're very good at doing.
5 minutes away from this news conference with Chairman Powell, we will, of course, take it in full right here on Bloomberg TV and on Bloomberg Radio. Can we play questions for the chair of the Federal Reserve quickly? Diane, first to you. What's the number one question for Chairman Powell in this news conference from your perspective?
What I think we really need to know is how high is their certainty right now? How good does he feel about the economy? Is he going to be as defiantly optimistic? How does he view, he will disregard the dot plot. I know that. He doesn't like it. We know they don't like it. He'll downplay that. But what he's got to do is say, how much does tapering, how can he decouple that from rate liftoff in rates, given the timing in what is in the dot
You do
plot.
wonder, Diane, why it's there.
The first question is, how do you decouple that?
Why is it there, then, if they don't want us to look at it? Quickly to you, Matt, your question for the chairman.
Exactly.
I would like to know how the Fed's thinking on inflation is evolving in real time. If you read the Beige Book, which I know not many people do, but if you read the Beige Book, there isn't a whole lot of evidence in there to suggest that inflation is proving to be as transitory as they might want it to be. So I would like to know, how is their thinking on inflation evolving?
Diane, the delicacies here are some scandal at the Fed of improper investments by senior officials. Does Chairman Powell need to address that in this press conference today?
Well, he'll be asked it either way, and I'm sure he's been prepped on it. And he's already said that they're looking into it and doing an internal examination of this. So this is something that they're going to take some issue on, and they're going to try to change policy on. And it is really unfortunate because it's not something we need to have on the Fed at this point in time. And I think that he takes that very seriously.
I've got too much respect, Diane, for your institutional excellence over the decades. Should Fed officials resign and save the chairman the agony?
That's a personal decision for them to make. I do think that this is a very difficult situation for the Fed right now.
TK, that was tough.
I have seen other people.
Look, let me explain this, folks. Diane Swank
trying to stay very diplomatic on this.
I know you're trying,
Diane. She was trying. Diane Swank has been through the economic wars more than anyone we speak to. And what she says about institutional integrity, John, particularly coming out of Ned Gramlett's Michigan, matters.
Do you think they've taken a massive credibility hit with all this, Tom?
You're asking me?
I'm asking
absolutely.
you. You think they have?
Absolutely.
Oh, yeah.
Diane, do you agree?
And I do agree, and it's really unfortunate. This is not, I can tell you from my Twitter feed what's coming at me, and I understand why people are angry. And this is something it's really hard. And we're talking about a very difficult time of income inequality, of wealth inequality, of inequalities that have gotten worsened by the pandemic. And it just is a really difficult thing. And I think this is something that the Fed is going to have to grapple with. And it is a shadow that we do not need on the Federal Reserve at this point in time. It's not as if everyone trusted the Fed coming out of the financial crisis, despite doing a lot to help the economy. People saw the divergence in wealth, and that they blame on the Fed. Yes, that is what part of the residual of the Fed's effects. It's also the Fed was the only one shouldering the burden of growth for a long time. But all that nuance gets lost in translation. And I think, unfortunately, credibility is really paramount for the Fed at this point.
Straight answer from Diane Swank. Matt Hornback, I don't expect a straight answer from you on this one. You're getting so much trouble with Morgan Stanley. You run. Matt Hornback over at Morgan Stanley. Thank you, sir. Diane Swank with us as well. Did you just see that in the face there, Tom? Matt Hornback just did not want to go there.
No, he did not want to go there.
PR over at Morgan
these are
Stanley
delicate issues.
They'd hate that. I get it. I get it.
These are delicate issues. But, John, to me, the distinction here, and I thought Diane Swank was beyond graceful there about unfortunate, is the issue is not the trading. If somebody bought Apple or, what was the tech stock, meme stock today everybody was talking about?
Whatever it was, Tom.
They're trading bond issuances, bond derivatives, bond ETFs. Come on. That's their wheels. I can't even own bank stocks. That's my handshake agreement with Matt
This is going to come
Miller.
up in the news conference. It begins in 20 seconds, and here's the price action going into it. Your equity market with a lift up 50 on the S&P 500. I know you're fired up about it. Up by about 1.3% on the S&P. Switch up the board and get to the bond market. Going into the Federal Reserve news conference with Chairman Powell. Yields in a couple of basis points to 130.23 on 10s, on 30s. Yields 183.97. Here's the Chairman of the Federal Reserve.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our current pace of asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to support the economy until the recovery is complete. Progress on vaccinations and unprecedented fiscal policy actions are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen, Real GDP rose at a robust 6.4% pace in the first half of the year, and growth is widely expected to continue at a strong pace in the second half. The sectors most adversely affected by the pandemic have improved in recent months, but the rise in COVID-19 cases has slowed their recovery. Household spending rose at an especially rapid pace over the first half of the year, but flattened out in July and August as spending softened in COVID-sensitive sectors, such as travel and restaurants. Additionally, in some industries, near-term supply constraints are restraining activity. These constraints are particularly acute in the motor vehicle industry, where the worldwide shortage of semiconductors has sharply curtailed production. Partly reflecting the effects of the virus and supply constraints, forecasts from FOMC participants for economic growth this year have been revised somewhat lower since our June summary of economic projections, but participants still foresee rapid growth. As with overall economic activity, conditions in the labor market have continued to improve. Demand for labor is very strong, and job gains averaged 750,000 per month over the past 3 months. In August, however, job gains slowed markedly, with the slowdown concentrated in sectors most sensitive to the pandemic, including leisure and hospitality. The unemployment rate was 5.2% in August, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs and ongoing fears of the virus, appear to be weighing on employment growth. These factors should diminish with progress on containing the virus, leading to more rapid gains in employment. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.8% at the end of this year and 3.5% in 2023 and 24. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower-wage workers in the service sector and on African Americans and Hispanics. Inflation is elevated and will likely remain so in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly because supply bottlenecks in some sectors have limited how quickly production can respond in the near term. These bottleneck effects have been larger and longer lasting than anticipated, leading to upward revisions to participants' inflation projections for this year. While these supply effects are prominent for now, they will abate, and as they do, inflation is expected to drop back toward our longer-run goal. The median inflation projection from FOMC participants falls from 4.2% this year to 2.2% next year. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, bottlenecks, hiring difficulties, and other constraints could again prove to be greater and longer lasting than anticipated, posing upside risks to inflation. Our framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of longer-term inflation expectations appear broadly consistent with our longer-run inflation goal of 2%. If sustained higher inflation were to become a serious concern, we would certainly respond and use our tools to assure that inflation runs at levels that are consistent with our goal. The path of the economy continues to depend on the course of the virus, and risks to the economic outlook remain. The Delta variant has led to significant increases in COVID-19 cases, resulting in significant hardship and loss, and slowing the economic recovery. Continued progress on vaccinations would help contain the virus and support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. Our asset purchases have been a critical tool. They helped preserve financial stability and market functioning early in the pandemic, and since then have helped foster accommodative financial conditions to support the economy. At our meeting that concluded earlier today, the committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. Since then, the economy has made progress toward these goals. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. We also discussed the appropriate pace of tapering asset purchases once economic conditions satisfy the criterion laid out in the committee's guidance. While no decisions were made, participants generally view that, so long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely to be appropriate. Even after our balance sheet stops expanding, our elevated holdings of longer-term securities will continue to support accommodative financial conditions. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. Half of FOMC participants forecast that these favorable economic conditions will be fulfilled by the end of next year. As a result, the median projection for the appropriate level of the federal funds rate lies slightly above the effective lower bound in 2022. Participants generally expect a gradual pace of policy firming that would leave the level of the federal funds rate below estimates of its longer-run level through 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. More important than any forecast is the fact that policy will remain accommodative until we have achieved our maximum employment and price stability goals. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you, and I look forward to your questions.
Thank you. We'll go first to Rachel Siegel.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. When it comes to the taper and eventually to any rate increases, I'm wondering if you can walk us through what substantial further progress looks like given the latest batch of projections that have PCE inflation coming in a little higher than the June projection, the unemployment rate also being higher than June, as well as the change to GDP lower than June. If you could help us make sense of all those things as you sort through what substantial further progress looks like, that would be great.
Sure. So the test for beginning our taper is that we've achieved substantial further progress toward our goals of inflation and maximum employment. And for inflation, we appear to have achieved more than significant progress, substantial further progress. So that part of the test is achieved in my view and in the view of many others. So the question is really on the maximum employment test. So if you look at a good number of indicators, you will see that since last December when we articulated the test and the readings today, in many cases, more than half of the distance, for example, between the unemployment rate in December of 2020 and typical estimates of the natural rate, 50 or 60% of that road has been traveled. So that could be substantial further progress. Many on the committee feel that the substantial further progress test for employment has been met. Others feel that it's close. They want to see a little more progress. There's a range of perspectives. I guess my own view would be that the substantial further progress test for employment, is all but met. And so once we've met those two tests, once the committee decides that they've met, and that could come as soon as the next meeting. That's the purpose of that language, is to put notice out that could come as soon as the next meeting. The committee will consider that test, and we'll also look at the broader environment at that time and make a decision whether to taper.
Thank you. We'll go to Howard Schneider.
Thanks, Chair Powell. Thanks, Michelle. So looking at the SEPs, we have now basically 4 years of inflation above target, and policy never gets to the long run rate. I'm wondering if you could address that from two perspectives. One, within the new framework that the Fed adopted last year, and second, from the perspective of the average household that's now being asked to pay higher prices and increasingly higher prices for 4 years running, when for some this year, real wages have actually gone down.
Sure. So as you can see, the inflation forecasts have moved up a bit in the out years. And that's really, I think, a reflection of, and they've moved up significantly for this year. And that's, I think, a reflection of the fact that the bottlenecks and shortages that we're seeing in the economy have really not begun to abate in a meaningful way yet. So those seem to be going to be with us at least for a few more months and perhaps into next year. So that suggests that inflation is going to be higher this year, and a number, I guess the inflation rates for next year and 2023 were also marked up, but just by a couple of tenths. Those are very modest overshoots. You're looking at 2.2 and 2.1, 2 years and 3 years out. These are very, very. I don't think that households are going to notice a couple of tenths of an overshoot. That just happens to be people's forecasts. We want to foster a strong labor market, and we want to foster inflation averaging 2% over time. And I think we're very much on track to achieve those things. In terms of the framework, I see this as very consistent with the framework. We want inflation expectations to be anchored at around 2%. That's really the ultimate test of whether we're getting this done under the framework. And we do want inflation to run moderately above 2%. I wouldn't put too much on a couple of tenths over 2% in 2023 and 24, 1 tenth in 24. But you're right; those are the numbers.
Thank you. Let's go to Colby Smith.
Chair Powell, thank you, Michelle. Chair Powell, you mentioned ongoing discussions about the tapering timeline, and I'm wondering what the contours of that debate have been. For those that want to move a bit more quickly, is it about maintaining optionality for a 2022 interest rate increase, or is it about financial stability risks or concerns about the efficacy of asset purchases at a time when we have supply constraints? Thank you.
So let me say that there's very broad support on the committee for this plan, both as to the timing and as to the pace of the taper. So this was a unanimous vote today, and I'd say quite broad support for this approach. You're correct that there are some who would prefer to have gone sooner, and they've made their arguments publicly. For some of them, it's a financial stability concern, and for others, it's other concerns. They can make their own arguments. This is an approach that the committee will broadly support, and it will put us, having completed our taper sometime around the middle of next year, which seems appropriate. The asset purchases, as I mentioned, were very, very important in the early stages of the crisis. They were essential in restoring market function in the Treasury and other markets. Then, as the recovery got going, they supported aggregate demand, as they will do. And now we're in a situation where they still have a use, but it's time for us to begin to taper them. Their usefulness is much less as a tool than it was at the very beginning. And of course, this leaves the whole question of rate increases ahead, which is really where the framework is all about, how we deal with rate increases and that sort of thing. So we think this is the appropriate way to go, and again, broad support on the committee.
Thank you. We'll go to Nick Timrose.
Hi, Nick Timrose of the Wall Street Journal. Chair Powell, you have said the test for liftoff is more stringent than the test for tapering. But if the near-term projections today are credible, more of your colleagues seem to think that rate liftoff and not just a taper may be closer at hand. Does the committee have a different opinion than you do about the threshold for liftoff that you've articulated, Or do they believe that either inflation or economic growth will necessitate a rate increase sooner than you do?
Well, so again, substantial further progress toward our goals is the test for beginning the taper. And the taper takes some months in everyone's figuring. So you're going to be well away from satisfying the liftoff test when we begin the taper. So in terms of the liftoff test, though, it's what we adopted last September. It's labor market conditions consistent with maximum employment. And while we have interesting signs that in many ways the labor market's very tight, we also have lots of slack in the labor market, and we think that those imbalances will sort themselves out. Inflation at 2% and on track to achieve moderately higher inflation over 2%. That really depends on the path of inflation. If inflation remains higher during the course of 2022, then we may already have met that test by the time we reach liftoff. So I just think if you look at what people are writing down for year-end 2022 numbers, some people are writing down very low unemployment rates, and that's only one indicator, but it suggests a very strong labor market. And I think they're writing down in good faith what they see as meeting the test. There's a range of perspectives about where the economy will be, but by the way, all but one participants have us lifting off during 2023. So it's not really an unusually wide array of views about this.
Thank you.
We'll go to Gina Smialik.
Hey, Chair Powell, thank you for taking our questions. Prior to recent media reports, were you aware of the kind of security buying and selling that Presidents Kaplan and Rosengren were participating in last year? And I wonder if you thought those were appropriate.
So, no, I was not aware of the specifics of what they were doing. So let me just say a couple things about this subject. We understand very well that the trust of the American people is essential for us to effectively carry out our mission. And that's why I directed the Fed to begin a comprehensive review of the ethics rules around permissible financial holdings and activity by Fed officials. So those rules are in many respects the same as those for government agencies, plus a number of things that apply specifically to us because of our business. One of those is sort of three things I would point to in terms of specific restrictions. One is ownership of certain assets is not allowed, and that's bank securities and other things. Secondly, there are times when we're not allowed to trade at all or to buy and sell financial assets, and that's the period immediately before and during an FOMC meeting. And third, there's regular disclosure. So all of these, everyone's ownership and activities are all disclosed on an annual basis. So I would have had to go back and read people's financial disclosures to know what their activities have been. This has been our framework for a long time, and I guess you'd say it's served us well. The other thing you would say that it is now clearly seen as not adequate to the task of really sustaining the public's trust in us. We need to make changes, and we're going to do that as a consequence of this. This will be a thoroughgoing and comprehensive review. We're going to gather all the facts and look at ways to further tighten our rules and standards.
Great, thank you. We'll go to Steve Liesman.
Thank you. Thank you, Mr. Chairman. I want to follow up on Gene's question. The issue of ownership of these stocks and trades, do you think it's appropriate for Federal Reserve officials to be owning the same assets that the Federal Reserve is buying? Is that one of the modifications that you're looking at? And in that, you said yourself they don't clearly not seen as appropriate. In that, the Fed's code of conduct says Fed officials should avoid even the appearance of conflict. Do those trades, in fact, and holdings violate the Fed's code of conduct? Finally, do you have a timeline as to when you might be done with your review? Thank you, sir.
Don't have a timeline yet. We can start with that. Well, let me address the muni question since that's in there. I personally owned municipal securities for many years, And in 2019, I froze that, meaning I'm holding all those securities, my wife and I, to maturity. And munis were always thought to be a pretty safe place for a Fed person to invest because, as you know, the lore was that the Fed would never buy municipal securities. So it was not an uncommon thing. And so then comes the COVID crisis, and I reversed that policy. And I did it without hesitating. And the reason was that the financial markets, and including the municipal financial market, were very much on the verge of collapse. And it was time to go, and we did. But we also checked with the Office of Government Ethics, who looked carefully at it and said that I didn't have a conflict. So that's one answer that I wanted to share with you. Secondly, you're right, though. We're going to be looking at all of those things. I don't want to get ahead of the process here and speculate about particular outcomes. But this, again, comprehensive and deliberate process. We're going to make changes. I want to be able to look back on this years from now and know that we rose to meet this challenge and handled the situation well, and that what we did made a lot of sense and protected the public's interest and the institution that we're all a part of.
I'm sorry, Chair Powell, I just want to follow up. You said I was right when you said right about that the Federal Reserve should not own the same assets they're buying. Is that what
I think that's a reasonable thing. Yeah, and of course, for the most part, we don't. I mean, it was a real coincidence. I happened to pre-own these munis. They were bought many years ago, actually, and so we started buying munis as part of the municipal liquidity facility. So it was really not it just was an unforeseen event, and I couldn't sell them. So what I did was I just held them, checked with the ethics people, and went ahead. So, but as a general principle, yeah, that makes a lot of sense.
Thank you.
Thank you. We'll go to Chris Rugaber.
Thank you. Thank you, Chair Powell. Well, I had a question about jobs and the Fed's schedule, the Fed's policy framework that you laid out here. You and other Fed officials have often talked about expecting a job market pickup in September as more children return to school, freeing up more parents to work, COVID abating. You mentioned in the past the extra unemployment benefits expiring. There's some real-time data suggesting that we may not be seeing much of a return of labor supply. So do you still expect to see that in the next couple of jobs reports? And how would a relatively weak jobs report in September affect your plans? Thank you.
So you're right. We have a really, I'll call it a unique situation where by many measures the labor market is tight. And 11 million job openings, very widespread reports from employers all over the economy saying it's quite difficult to hire people, wages moving up and that kind of, so quite a tight labor market. So our view, I think a widespread view a few months ago was that several things were coming together in the fall, including kids back to school, which would lighten caregiving duties, including the expiration of extra unemployment benefits, and other things would come together to provide an increase in labor supply. And so we'd get out of this strange world where there are lots of unemployed people and a high unemployment rate, but a labor shortage. And so what happened was Delta happened. And you have this very sharp spike in Delta cases. And I think, so that affects, for example, when schools are open 60% of the time, or when they're always at a threat of being closed because of Delta, the Delta variant, you might want to wait rather than going ahead and taking a job and starting work only to have to quit it 3 weeks later. You're going to wait until you're confident of that. So some of that may not have happened. Also, people didn't, as you know, hiring and spending in these face-to-face service industries, travel and leisure, it just kind of stopped during those months. So that really the big shortfall in labor in jobs was largely in travel and leisure, and that's clearly because of Delta. So that all happened. And so what we know is that it didn't happen. I think there's still, it may just be that it's going to take more time, but it still seems that inexorably these are people who were largely working back in February of 2020. They'll get back to work when it's time to do that. It just may take longer time. You're right, though. It didn't happen with any force in September, and a lot of that was Delta. In In terms of you asked also about the test for November. I think if the economy continues to progress broadly in line with expectations, then I think, also the overall situation is appropriate for this, then I think we could easily move ahead at the next meeting, or not, depending on whether we feel like those tests are met.
Well, if I could just quickly follow up, I mean, how much of that will depend on what kind of jobs report we get for September? And I mean, is it, are you in a data-dependent phase here where you need to see certain numbers going ahead, or are we at a point where you've accumulated enough progress that?
So it's accumulated progress. So for me, it wouldn't take a knockout, great, super strong employment report. It would take a reasonably good employment report for me to feel like that test is met. And others on the committee, many on the committee feel that the test is already met. Others want to see more progress, and we'll work it out as we go. But I would say that in my own thinking, the test is all but met. So I don't personally need to see a very strong employment report, but I'd like to see a decent employment report. I mean, it's not to be confused with the test for liftoff, which is so much higher.
Great, thank you.
Okay, thank you. We'll go to Victoria Guida.
Hi, Chair Powell. So I wanted to ask about the Vice Chair of Supervision position, and I was wondering if you could speak about how you view that role and the extent to which you defer to that person on regulatory policy. And then just sort of a related question, as you know, Randy Quarles' vice chairmanship ends next month, and I was wondering if he's going to retain the supervisory portfolio until he's replaced in that role.
Sure. So Dodd-Frank created this position, Vice Chair for Supervision, and there's actually a specific assignment in the Dodd-Frank language, as I'm sure you know. And effectively what it means is that the Vice Chair for Supervision is charged with setting the regulatory agenda. And, it's a specific grant of authority. And in the 10 years almost that I've been at the Fed, that person has really done that. Dan Tarullo certainly did it, and Vice Chair Quarles did it as well. And I think I respect that authority. I respect that. That's the person who will set the regulatory agenda going forward. And I would accept that. And furthermore, it's fully appropriate to look at, for a new person to come in and look at the current state of regulation and supervision and suggest appropriate changes, and I welcome that. In terms of Vice Chair Quarles' term, we're not currently in that situation, and I actually don't have any updates for you on that today. We'll keep you posted on that.
Thank you. We'll go to Steve Matthews at Bloomberg.
Thank you. Chair Powell, I wanted to ask about the inclusive monetary policy framework. In particular, Bloomberg surveyed economists, and we found that they predict liftoff will happen when the U.S. unemployment rate is 3.8%, but the Black unemployment rate is 6.1%. And I'm wondering if a 6.1% unemployment rate for African Americans is consistent with full employment, or whether it would need to be lower as part of your inclusive growth strategy.
Right. So the point of the broad and inclusive goal was not to target a particular unemployment rate for any particular group. Really, we look at a broad range a very broad range of metrics when we think about what maximum employment is. And one of the things we look at is unemployment rates and participation rates and wages for different demographic and age groups and that kind of thing. So we will do all of that. So I think if you look back, what were we really thinking? So we all saw the benefits of a strong labor market. If you look at the last 2 or 3 years of before the pandemic hit, you saw, after a lot of long progress, you saw a really strong labor market, and you saw wages at the low end moving up faster than everywhere else, something that's great to see. We also saw the lowest unemployment rates for minorities of various, for African Americans, for example, and also participation rates. I mean, we saw a really healthy set of dynamics. And by the way, there was no reason why it couldn't continue. There were no imbalances in the economy, and then along came the pandemic. There was nothing in the economy that looked like a buildup of imbalances that could cause a recession. So I was very much thinking that the country would really benefit from a few more years of this. It would have been great. So we're all quite eager to get back to that. We also said we wouldn't raise rates just in response to very low unemployment in the absence of inflation. So that was another aspect of it, because we saw that really benefited labor market participants in a broad and inclusive way. That's, of course, not the current situation. We have significant slack in the economy and inflation well above target, not moderately above target. So that's really how we think about it. It isn't really just targeting the headline numbers, but it's about taking all of those things into account in your thinking about what constitutes maximum employment.
I guess just to follow up, should there be a significant gap between Black unemployment and overall unemployment for structural reasons that are outside of the control of the Fed that other people should be doing something about? Or should the gap be narrowed, if not down to zero?
Well, first of all, ideally there wouldn't be any gap, of course. We would all love to see no such gap. This is a persistent gap, and it's very hard to explain based on typical metrics. It's quite troubling, but it really is. We have famously broad and blunt tools. I think eliminating inequality and racial discrimination, racial disparities, and that kind of thing is really something that fiscal policy and other policies, frankly, education policies and that kind of thing, are better at focusing on. I think we've identified the part that we can do, and we'll do that part. But I've always been clear that it's going to take policies broadly across society to work on these problems.
Thanks.
Thank you. Let's go to Michael McKee.
A plan for dealing with a debt default that included prioritization, that included changes in bank regulations, and possibly selling defaulted or non-defaulted treasuries and buying those who are that are. Are any of all of those still on the table? Do you think any of those would work? And what would happen to the economy, in your view, should the debt ceiling not be raised?
So I missed the first few words, but I think I got your question. So it's just very important that the debt ceiling be raised in a timely fashion so that the United States can pay its bills when and as they come due. That's a critically important thing. The failure to do that is something that could result in severe reactions, severe damage to the economy and to the financial markets, and it's just not something that we could contemplate, that we should contemplate. I'm not going to comment on particular tactics or things like that. I'm just going to say that I think we can all agree that the United States shouldn't default on any of its obligations, should pay them when and as due, and that no one should assume that the Fed or anyone else can protect the markets or the economy in the event of a failure, fully protect in the event of a failure to make sure that we do pay those. That's when they're due.
Good. If I could follow up, have you discussed options with members of Congress?
I don't generally ever talk about the conversations I have with elected officials or other appointed officials. But look, you can see that this is a major focus among those who have responsibility for it, and including elected people.
Thank you. Let's go to Hannah Lang.
Hi, thanks so much. Senator Warren sent you a letter last week urging the Fed to break up Wells Fargo, citing what she called ungovernable behavior from the bank. I was just curious, under what circumstances would the Fed actually consider revoking a financial holding company's license, and if the indiscretions at Wells Fargo, in your opinion, warrant such an action?
So we're, of course, very closely monitoring Wells Fargo's efforts to fix its widespread and pervasive problems. They represent a serious matter to us, and the firm is required to remediate them. And we will take appropriate supervisory action if the firm fails to meet our expectation. We continue to hold the firm accountable for its deficiencies with an unprecedented asset cap that will stay in place until the firm has comprehensively fixed its problems. We're not going to remove that asset cap until that's done. Bottom line is we'll take strong supervisory action if a firm is engaging in unsafe and unsound practices or violating laws, but I can't speak to our confidential supervisory assessments of any individual bank.
Thank you. Now we'll go to Michael Derby.
Thank you for taking my question. You noted earlier in the press conference that you weren't aware of the trading activity of the Boston and Dallas Fed bank presidents. As you know, all 12 regional Fed bank presidents just went through the renomination process earlier this year, and Governor Brainerd described it as a rigorous process at the time. So I want to know, did anybody at the board level know about the stock trading activity? And going forward, do you still have confidence in the Dallas and Boston Fed bank presidents to do their job?
So these, I don't need to tell you, people file these reports annually, and I think they were just quite recently filed for 2020. So I don't have any reason to think people at the board would have known about particular trading that's going on. They will see that. There are people at the Fed who see that. See the trading reports when they're annually filed. In terms of having confidence in that sort of thing, I think no one is happy. No one on the FOMC is happy to be in this situation, to be having these questions raised. It's something we take very, very seriously. This is an important moment for the Fed, and I'm determined that we will rise to the moment and handle it in ways that will stand up over time. I'm very reluctant to get ahead of the process and speculate, though, about different things. And when we have things to announce, we'll go ahead and do that. But that's really what I have for today.
So one small follow-up. I mean, I know that you didn't have the 2020 forms in hand, but you would have had past year forms in hand. And at least in the case of like the Dallas disclosure forms, similar trading activity was shown in years past. So that in theory could have been something that came up in the renomination process.
So that's a good question. So, the 5-year review that we do under this unusual provision of law where all of the Reserve Bank presidents are reviewed for reappointment at the same time every 5 years, that is really a broad review about their leadership of the institution, their performance on the FOMC, all of those things. And if there were a concern, a public concern or a private concern about something that someone had done, we wouldn't wait for the 5-year. We wouldn't wait that day if there were concerns. You're right, though. These, as I mentioned, we have had a framework for a long time, and it's similar to what other government agencies have, only it's a little stricter. And it is that you can trade financial instruments, but not specific ones like bank debt. You can't trade during the FOMC period and during the meeting, the blackout period, and then during the meeting. And then you disclose all this. And we have disclosed it for years. So all of these things have been going, to the extent they've been going on, they've been a matter of public record. And, but nonetheless, so that, it was seeming to work just okay. And now you look at it and you see this and you think, we need to do better, and we will. But you're right. But it has not been part of the process, and appropriately, I don't think it should have been. I mean, I wouldn't blame the people who conduct that review. I really think if someone had raised concerns or if we'd had concerns, then it would have been, but it wouldn't have been part of that process. It would have been raised instantly rather than once every 5 years.
Thank you.
Thank you. Let's go to Jean Young.
Thank you, Michelle. Chair Powell, I wanted to ask about how the Fed would balance the two parts of its dual mandate. If inflation stays elevated, but we still have a labor shortage and participation remains lower than ideal, would you hold off on raising rates, or how would you think about that? Thank you.
Well, let me say one thing. you're looking for conditions consistent with maximum employment to lift off. And those conditions can change over time. So you're not necessarily bound by a particular level of the unemployment rate or the participation rate or anything else like that, which can change over time. But more to your point, really, we actually have a paragraph in our framework, and something like this has been there for a long time. I think it's paragraph 6. And you're talking about a situation in which the two goals are not complementary; they're somehow in tension. And if we judge that is the case, what it says is we take into account the employment shortfalls and inflation deviations and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with mandate. So we used to call that the balanced approach paragraph because it had those words. So it's a very difficult situation for any central bank to be, to be in a situation where the two goals are in tension. And that paragraph tries to address it by saying we would sort of weigh the equities between the two, how long will it take, and how big are the gaps, and that kind of thing. We don't really think we're in that. We're sort of in that situation, I'd say, in a short-term way, but we think we do expect that that this is sort of because of the COVID shock and the reopening and all that, you're seeing this temporarily.
Great. Thank you. We'll go to Edward Lawrence.
Thank you, Michelle. Thank you, Mr. Chairman, for taking the question. So on corporate debt, what happened with Evergrande that we've been watching, is that a preview of what could happen with the amount of corporate debt that's out there? In the past, you've said you're watching the level of corporate debt. So what's your level of concern right now? And would you consider the Evergrande Group issue a sort of a warning signal?
About the United States? No. Corporate defaults are very low in the United States right now. Corporate leverage built up over the course of the long expansion that ended with the pandemic. We were very concerned in the last year or so. We were concerned in the last year or so, and then I'd say very concerned at the beginning of the pandemic that if you've got a highly leveraged company and your revenue stops for an uncertain period, as things happened at the beginning of the crisis, we were very concerned that there would be a wave of defaults. Didn't happen, potentially, to a significant extent because of the CARES Act and the response that we undertook and all that. It was a much stronger response than we've ever had. And I think for whatever reason now you have very, very low default rates now among corporate debt. The Evergrande situation, it seems very particular to China, which has very high debt for an emerging market economy, really the highest that any emerging market economy has had, and the government has been working to get that under control. This is part of that effort. The government put new strictures in place for highly leveraged companies, and Evergrande is dealing with those strictures, and it's something they're managing. In terms of the implications for us, there's not a lot of direct United States exposure. The big Chinese banks are not tremendously exposed, but that you would worry that it would affect global financial conditions through confidence channels and that kind of thing. But I wouldn't draw a parallel to the United States corporate sector.
Thank you. We'll go to Brian Chung.
Hi, Chairman Powell. Just wondering if you could give us an update on whether or not you've had conversations with the White House about a possible reappointment, and then whether or not you would like to be reappointed as this chatter kind of builds up. Thanks.
I think the phrase goes, I have nothing for you on that today. Sorry. I'm focused on doing my job, every day for the American people, and I don't have any comment on that, Brian.
Sorry about that. Let's go to Greg Robb.
Thanks for taking my question, Chair Powell. I was wondering if in your discussion about the tapering, that you said that officials think it's appropriate to end around the middle of the year. If there was any discussion about what happens to the balance sheet, then I've heard some Fed officials say that they would shrink the balance sheet. Was that discussed, and what's your stance on shrinking the balance sheet? Thanks.
So my thinking on this has been, let's get through the taper decision, and then let's turn to those issues. There are a number of related issues. You mentioned one, Greg, but and which you need to start to think about, and we'll do that. But we want to get through this taper decision and then turn to those issues, rather than start, thinking about them now and having the minutes discuss them and get people thinking that we are, focused on those issues, because we're really not. And we do have the experience of what we did last time. We've watched other countries and what they've done, so I think we'll be able to get to sensible decisions fairly expeditiously when it's time, but it's just not time yet in my thinking.
Thank you.
Thank you. Let's go to Scott Horsley.
Thank you, Mr. Chairman. You talked a little bit about inflation expectations, and there does seem to be something of a divide between market expectations and the views of professional economists, which are pretty much in line with the FOMC members, and lay people's expectations, at least as reflected in the recent New York Fed survey. How much weight do you put on lay people's expectations, and what do you think accounts for that divide?
So let's just take the household surveys generally. The New York Fed survey, let me talk about that specifically, and this is from the New York Fed. It's only an 8-year-old survey, and it does seem as though they're looking 3 years out, and it seems like there's a high correlation between 3 year and 1 year. For the most part, surveys are showing that households expect higher inflation in the near term, but not in the longer term. And that's also what expectations are showing. So there are many, many different inflation measures, of course, and that's why we have this thing called the CIE, which is it's an index of it's market-based measures, it's professional forecasters, and it's household surveys. And you just put them all. It's not, it doesn't have a lot of grand theory about it. You put them all in, and you measure the change. So you should be, and also you measure things like the dispersion and that sort of thing. So you can look at all of that, and it tells a story of inflation expectations moving up. Many of the different measures will also show inflation expectations moving back up to where they were in, say, 2013, which was before the drop in inflation expectations broadly happened in 14 and 15, around then. So. That's not a troubling thing, but inflation expectations are terribly important. We spend a lot of time watching them, and if we did see them moving up in a troubling way and running persistently above levels that are really consistent with our mandate, then we would certainly react to that. But we don't really see that now. We see more of a moderate increase that is in the first part of which is welcome, and because inflation expectations had drifted down, and it was good to see them get back up a bit, but again, we watch carefully.
Thank you. Let's go to Heather Scott.
Hi, sorry. You caught me off guard. Thank you, Chair Powell, for taking my question. I really appreciate it. Again, on the taper timing, you say it's going to last till the middle of next year, but with your concerns about the potential for upside risks to inflation, would you think you might need to have liftoff happen before you finish the tapering?
That's not my expectation. Of course, we can always. We haven't decided to taper yet, and we haven't decided the pace yet. So It's not my expectation that we would have to. We can certainly speed up or slow down the taper if it becomes appropriate, though. Absolutely. In fact, back in 2013 when we tapered, we always said we weren't on a preset course. I think this will be a shorter period. The economy is much farther along than it was when we tapered in 2013. So it makes sense to allow the runoff to happen. It's a very gradual taper. It will be when we agree on it, and. But we certainly have the freedom to either speed it up or slow it down if that becomes appropriate.
But you wouldn't expect rate liftoff to happen until you're finished with that process?
It wouldn't. No, because when you're as long as you're buying assets, you're adding accommodation, and it wouldn't make any sense to, then lift off. I mean, what you would do is you'd speed up the taper. I think if that were the situation you're in. We don't expect to be in that situation, but I do think it would be wiser at that point to go ahead and speed up the taper, just because the two are then working in the same direction.
Great, thank you.
Thank you.
Okay, for the last question, we'll go to Jeff Cox.
Thank you, Mr. Chairman, for taking the question. I just wanted to check in with you to see if you have an update at all on the efforts from the Fed to develop a central bank digital currency. I believe that the report was supposed to come this summer, and indications that it's going to come this month. But the drumbeat seems to be kind of getting louder to see where the Fed's heading on this, and just wondering if you can provide some update there.
Sure, I'd be glad to. So we think it's really important that the central bank maintain a stable currency and payment system for the public's benefit. That's one of our jobs. We also live in a time of transformational innovation around digital payments, and we need to make sure that the Fed is able to continue to deliver to the public a stable and trustworthy currency and payment system. So there's extensive private innovation, a lot of which is taking place outside the regulatory perimeter, and innovation is fantastic. Our economy runs on innovation. But where the public's money is concerned, we need to make sure that appropriate regulatory protections are in place, and today they really are not in some cases. So with that in mind, and with the creation of myriad private currencies and currency-like products, we're working proactively to evaluate whether to issue a CBDC, and if so, in what form. We have two broad work streams, one of which is really technology, both at the board and in the Federal Reserve Bank of Boston's work with MIT, the other of which is to identify, scope out, deal with, analyze the various public policy issues. As you mentioned, we do intend to publish a discussion paper soon that will be the basis for a period of public engagement with many different groups, including elected officials, around these issues. We think it's our obligation to do the work both on technology and public policy to form a basis for making an informed decision. The ultimate test will apply when assessing a central bank digital currency and other digital innovations is, are there clear and tangible benefits that outweigh any costs and risks? We're also, as you know, investing heavily right now in building a new settlement system for instant payments in the U.S. It'll be the first such major expansion of our core payment system since the 1970s. We found the case for this quite compelling. For consumers, businesses, and just ensuring that all financial institutions have access to the payment system. So bottom line, we haven't made a decision about the CBDC, but we will be issuing a discussion paper soon in order to form the basis of this public interaction that we'll have. Thank you very much.
If I can have a quick, can I get a quick follow on that?
The chairman of the Federal Reserve, as many look for a quick follow-on to what I thought, folks, was the most interesting press conference we've had in ages. Here's our plan. We're going to look at the equity markets with Romain Bostic, Michael McKee, of course, with perspective out of the conference. And then we have two esteemed guests to drive forward the conversation. On radio and television, we welcome all of you across this nation and around the world. The central banker of the world has spoken. Kayleigh Lyons with me right now. John Farrow is on assignment. As I say, Kayleigh, your first observation.
Well, I actually think this was a more hawkish Powell than maybe the market anticipated. Not that we're seeing the subsequent market reaction, and I know Romain will take us through it.
Yeah.
But I thought his language around the taper was actually quite interesting. When asked about kind of the efficacy of asset purchases at this point in time, he said that they still serve a purpose, but it is time to taper them. He didn't use the word soon. He didn't use the phrase by year end. He said now is the time. And I wonder if that's a little bit more hawkish than even the statement projected. Tom.
A round trip Fed, they go up on the statement, then we advance downward. And with the dialogue that we saw, particularly Colby Smith over at the FT and him talking about financial stability, we saw some real market movement. Romain Bostic, we return here near up 500 Dow points. What's it mean?
Yeah, well, I don't know what it means for the Dow, but with regards to the broader market here, this is a market that you're basically being boxed in right now. So whether you believe that timetable here on the taper, and that takes us out to mid-2022, and you start to look ahead to the potential for rate hikes and those two dots coming into 2022 here, the question is, where do you go here when you look at the moves that we saw in the bond market? You have to pretty much stay committed to this, at least in the short term, Tom, and maybe short term ends up being 3, 4, 5 months.
Romain Bostic, dovetail what you heard from the chairman of the Fed on economics with what we heard from Federal Express with their challenges of labor expense?
There's a huge disconnect here, and I don't think Jay Powell is not being sincere. I think he and most of the participants truly do believe in some of the more ephemeral elements of some of the inflation that we're seeing. When you look at, he mentioned the CIE, you look at some of those five-year forward rates, that actually plays out, Tom. You see expectations have come down significantly from where we were back in March, where we were back in May here. So he has a leg to stand on, but on the ground here, people are seeing something a lot different.
Romaine Bostic, sell us on a close here. What are we going to do at 4 p.m.?
Yeah, all right. Well, we're going to talk a lot about the inequality issues that were brought up here. And more importantly, we're going to talk a lot about the trust in the market and the trust in the Fed, I should say, by the market here. So it's something you want to definitely stay tuned for. And we'll get to that a little bit later on.
Good conversation with Romaine Bostic and all on the close here coming up in a moment. Good conversation always with Michael McKee. The headline, of course, not the final question this time around. But Mr. McKee, good afternoon to you. Michael, to me, it was a really, really interesting press conference. Did he read more off prepared statements than you've ever seen?
He brought a script.
I don't think so, but he was obviously well prepared to answer a lot of the questions, certainly about the conflicts of interest for Fed bank presidents. And he was asked even if that had come up in their annual 5-year reviews, and he had an answer for that. And obviously, when he was asked about whether he wants to still be chairman, he had a well-rehearsed answer for that. But I think they have made a significant move in their policies, and he did a good job of explaining it and actually telling the market something about what's going to happen, letting them know how long the tapers last, suggesting that they do believe inflation will come down, but if not, they would speed up the taper and then get to rate increases. So a lot of news in there. I did want to mention we lost our feed a little bit right at the end. He was asked if the Fed feels it is behind on central bank digital currencies. And he said, no, they're not behind. More important to get it right. But he said, if anything were to go forward, we would need the cooperation of Congress. And so he's taking it out of the Fed's portfolio and sending it up to the Hill.
And also maybe Gary Gensler's conference as well. Mike, I got to ask one quick question to you before we go to Jeffrey Rosenberg and Michael Ferroli. And Mike McKee, that is, how far out is this Fed looking? Ira Jersey makes note that this is a Fed considering 2024 and maybe with a lower set of interest rates out 2024. Do you agree with that?
No, they're required basically by their rules to set a forecast for 2024, but they don't believe really any of it, particularly the interest rate levels, given that there's no way to really tell what's going to happen with the economy. And because there is a possibility that by 2024, we will have 8 new members on the Open Market Committee, 4 governors and 4 bank presidents. So there's no way they could say this is what's going to happen, or even that we have a lot of confidence in what's going to happen.
Michael McKee, congratulations again on your leadership, and we'll see tomorrow more from Michael McKee, I'm sure, on Bloomberg Surveillance early in the morning. Michael Ferroli coming up from J.P. Morgan. That'll be an important economic discussion. But someone wonderfully holistic about the fixed income markets is Jeffrey Rosenberg. Yes, he's portfolio manager of Systematic Multi-Strategy Fund. Kaylee, I have no idea what that means. All I know is Rosenberg can synthesize what we saw in the spread market better than anyone.
Yeah, all I know is that I want to talk to Jeff about this Fed decision. So, Jeff, we've seen, as Tom alluded to with spreads, it's a flatter curve. Do you expect that to persist as the Fed makes progress toward potentially bouncing a November taper?
You know, I'm not so sure. That the flatter curve is kind of an initial response. But, you know, you look at this meeting and, you know, it's what the market has been waiting for. You know, everybody can exhale. We've been waiting for the meeting where they finally talk about tapering. This is it. And you look at that market reaction, and yes, the curve is flatter, but it's you got to squint to see that market reaction. This is a very good outcome for the Fed in terms of signaling their intent to give the market information well ahead of the tapering decision. The tapering decision looks like it's going to be announced at the next meeting, and the pace looks like it's $10 billion on treasuries and $5 billion a month on mortgages, and you're done by the middle of next year. And he kind of laid out that plan it's pretty close to what the market expected. And so you got, not very much reaction, and certainly, lots of other things going on in the world, but, not a down day on equities, no big surprises. So I think the Fed has got to be pleased that their communications on the long-awaited tapering has avoided the dreaded fear of the tantrum.
Yeah, absolutely. And I mean, obviously, the market moves that we're seeing in the bond market, definitely subtle, but certainly something to take note of. I am curious, Jeff, here about some of the chairman's comments, particularly about the employment side of the equation here, and the idea that he's looking at the next couple of employment reports and not necessarily not looking for a knockout, but it's basically just something that would maybe be, in quote his words, reasonably good. What is reasonably good going to look like?
Yeah, it's a continuation of the positive trends of labor market healing and no, significant negative surprises. Last month was really had the Delta variant over it. I think they're looking for a resumption to the trends that we saw before that. And it's important that the tapering and even the forecasts of tightening that we saw today, they're all conditional on the progress of the economy and no surprises. So that includes the progress that's implicit in those forecasts on the labor markets continuing to move towards maximum employment. Most people have that forecast, and that's why you saw the dot plot. Most people, I should say, have that forecast realized, and that's why you saw the dot plot do what it did today, pricing in liftoff in 22, and then 3 hikes in 23 and 3 hikes in 24. So you need to get that in the data, and that's what they're expecting.
Do you buy the dot plot, Jeff? Do you care about it? Because it seems like a lot of people don't.
Well, the further out you go, I think Mike McKee mentioned this and others, including Powell himself in the press conference, it gets discounted because it doesn't get realized. It is a statement, however, of what the committee is thinking today about near-term policy. And if there's any kind of important impact about today, tapering, tightening, it's that, we're in a very kind of unique period where the Fed is talking about moving towards being less accommodative. And when you have that in the environment where you have shocks like what we saw yesterday and like what we've been dealing with for some time here around Chinese growth and Evergrande and the credit concerns, it sets the market a little bit more on edge when you can't expect the Fed to respond to those market shocks because the Fed's telling you, oh, no, we're talking about and we're focused on the real economy. And what Powell talked about in his answer to the question about, well, financial condition tightening, Fed can't really pivot towards addressing that financial condition tightening as fast as market participants would want them to do. So it sets you up in an environment for a little bit more sensitivity and vulnerability towards those financial market shocks.
Jeff, it's Mike McKee. Before we let you go, I want to get your thoughts on a couple of the tangential issues that came up today. One is the doubling of the counterparty limits on reverse repos. It seems like the Fed is acknowledging that there is way too little paper out there in the markets, and there may be less going forward. And then also the idea that whether or not the markets are taking the debt default idea seriously. He obviously dodged the question on that. But at some point, do we see a reaction?
On the second question, absolutely. There is a point at which you could see a reaction if the markets are surprised. Markets are pricing, this not to go to the final hour and certainly not to have any kind of technical default situation, and that reasonable minds would prevail. We've seen this movie before play out, and at the last minute, if that doesn't show up, certainly markets will take note and start pricing that potential in. On the first part of the question, yeah, this is just more evidence of the size of the liquidity in the market overwhelming, the Fed's ability to control and trying to stay on top of that and recognizing that the size of the program needs to be increased given the size of the liquidity.
What's the market reaction going to be, Jeff, when we get to the end of this taper, whenever the timetable is, whether it's 6 months out, 10 months out here? Do you get a market that then starts to react to the potential for rate hikes, or is that now going to sort of be baked into whatever the tapering process is?
The last time we saw the taper, after they made the announcement it was going to be $10 billion a month and $5 billion a month or whatever the last period was, I'm forgetting, but that's what the new period was. it stops being news, right? We have what I call dino vision from that scene in Jurassic Park. We can only see what's moving, and we focus on the change. Once the Fed announces they're tapering 10 billion, 5 billion a month, it's not really going to be news. We'll focus entirely on liftoff and the timing of liftoff, and that will be the discussion. And as the earlier question said, those out years aren't really going to matter. It'll be all about that pace of tightening. Does it accelerate? Does it get pushed back into 23 because of whatever shock and news and development on the economy we're dealing with then?
Jeff, I'm wondering what this means for the trajectory of Treasury yields, because after the Fed decision and then after Powell's statement, we basically made a round trip and we're right back at 131, where we've been now for about a month. Is the Fed going to be the catalyst for that breakout, or do we continue to hold in this range?
Well, I think if you get to really pricing and the believability that you're pricing in a full tightening cycle, and you've got the growth story that's supportive of that, and you're avoiding outside shocks. It's important to remember the last 4, 5, 6 weeks have been nothing but kind of negative shocks to the outlook. And in that environment, that really holds those longer term interest rates in, and that's partly why we've seen that. If you get into a different kind of environment where the shocks are more balanced, or even that the shocks are turning out to be towards the positive side, you can break out of that range. And certainly the Fed's going to need that kind of more balanced outlook with regards to economic outcomes, both positive and negative, more balanced in those, to be able to make good on those forecasts. And as the market recognizes that and the environment supports that, then I think you can break out of that range into a higher range. Near term, I don't think that's the story, but when you look into 2022, definitely could be on the horizon.
So then what do you do with positioning near term with a potential taper announcement coming in November and looking towards 2022?
I don't think there's a huge amount of surprise in the taper discussion in November. I don't think it's particularly market moving. I think it's hard in the short run to really break out of that range. So I don't think there's a huge positioning change that is required, out of this news. And I think, the other news that we have to keep in mind here, is a potential, for surprises. And the surprises go on both sides. Most of the surprises, as I was just mentioning, have been on the deflationary side, on the negative side. That's kind of helped to hold in Treasury rates. But you were talking earlier about the labor and the wage inflation numbers. If we start to see surprises on the other side, then, that can be another catalyst for breaking out and perhaps a trigger for re-entering, a little bit of shorter duration positioning, a little bit more curve steepening kind of positions if we were to see those kind of inflation numbers that really challenge the transitory story and really support a more persistent story of inflation. I don't think that's happening out of today's news, but that's what we'll be looking for.
Jeffrey Rosenberg, thank you so much with BlackRock. Greatly appreciated this morning. The sum of all this is we need to stagger to November and then on to December with an earlier December meeting as the year ends. There is no one better to drive this forward than Michael Feroli of JP Morgan. He is their chief U.S. economist, and he is definitive out of Booth School in Chicago with his call on potential GDP. The truth is, Michael Feroli, my kids have never seen a normal American economy. You called this. You said we would see weaker GDP along the way. Do you stand by your potential GDP call of near 2% or even below 2% as the ultimate challenge for this Fed?
I think that's right. I think potential GDP growth still looks like it's below 2%. We saw that. The Fed shares that view as well, and we saw that just today in their longer run growth projection of 1.8%. I'm actually a little more pessimistic than that on potential GDP growth, but certainly the demographic trends are moving that way, and if potential GDP growth stays that low, R-star, which is the neutral real interest rate, will also remain low, and so the Fed will, in decades to come, probably have to, continue to worry about the zero lower bound problem, even if it's looking less of a problem right now, given the inflation outturns we've seen.
Young David Stubbs in London has been brilliant on the technology overlay of the JP Morgan optimism. Can you report to us today, Dr. Feroli, and frankly to Chairman Powell, that it will be technology to the American rescue?
Well, in the long run, of course, it's always not always technology, but primarily technology that drives long-run growth. I think we did, in spite of having a somewhat subdued view on potential GDP growth, we did have a nice burst of productivity growth over the past 6 quarters. It does look like some of the pandemic may have forced some rethinking of work processes, and we see in certain service sectors in particular a tick up certainly in the level of productivity. Now, whether that will translate into growth in productivity, ongoing growth in productivity, I think is a tougher thing to say. And I think one of the reasons you may have noted that a lot of people have been downgrading their assessment of current quarter GDP growth. Some of that has come from capital spending, which had a nice boost early in the recovery. Now looks like it's moderating. And without ongoing capital spending growth, it's kind of hard to see that productivity growth take us back up to above 2% trend GDP growth.
So tied into that GDP growth, tied into capital spending, is, of course, consumer spending. And, Michael, tied right into that, of course, are inflation expectations. You heard the chairman a little bit earlier today. He seemed to suggest that some of these inflation overshoots aren't necessarily going to be felt as hard as some people may think, at least with regards at the household level. Is that your case here?
Yeah, I think that's probably about right. I think the chairman pointed out that near-term inflation expectations are very elevated. I think longer term, it's a little more mixed. Certainly the New York Fed survey measure is a little higher than the University of Michigan survey measure. But overall, I think it's held in pretty well, just given how, how much of an upward surprise in inflation we've had over the past 4 or 5 months, how much that has made it onto the headlines and into the general news, and the fact that, the folks in Peoria still think that in the next couple of years, inflation is going to come back down to the trends we've seen is, I think, a testament to that stability.
All right. Well, someone who grew up not far from Peoria, I am curious. I get a lot of questions from family members about this, and I am curious, for those of us who aren't economists, for those of us who don't have your pedigree, Michael, how quickly can inflation expectations change? And by inflation expectations, I'm talking about real people on the ground, not just the CEOs, not just the folks out here managing money.
Yeah, well, we really only have one instance of longer-term inflation expectations persistently moving dangerously higher, and that was the late 60s into the 70s. And that process took several years of strong inflation, of strong wage growth before it really filtered into to people's expectations and into the market's expectations. Now, you don't want to rely on that type of, if you're at the Fed, you always have to be concerned that, it could be quicker this time, but the one time we've really seen inflation expectations break out to the upside, it took a number of years for that to occur.
Let's talk about the other part of the dual mandate, Mike. When we talk about employment and maximum employment, Powell said time and again in the press conference that what you need to start tapering is very different than what you need for actual rate liftoff, that even a decent September jobs report is going to be fine in terms of pulling back asset purchases. But for rate liftoff, does the Fed need to rethink about what maximum employment is coming out of the pandemic, where their participation rate may just be structurally lower?
I think you heard hints of that from the chairman today when he said there are some indications that the labor market could be very tight. Kind of walked that comment back, but I do think it probably is indicative of the chorus of voices around the FOMC, many of whom are pointing out just what you said, which is particularly on participation, which seems to be the largest measure of shadow slack, let's say. If that is at a natural level right now, then the unemployment rate really is a useful indicator of where we are, and that means that we don't have much further to go till we're at full employment. So I do think the participation rate puzzle right now is probably front and center in terms of thinking about the timing of liftoff. And as Powell noted, we haven't seen some of those odd factors that maybe have been holding down the participation rate. So parents who maybe have their children homeschooled and people who may be receiving unemployment benefits, that ended, and we haven't seen much of a shift yet. So I do think that's the participation rate puzzle is the really big one for the Fed over the next year.
Dr. Feroli, thank you so much. Look forward to weekly prospects published worldwide, 7 p.m.-ish Friday night. Michael Feroli at JP Morgan. Markets sustained, Dow up 400 points, SPX up 48, 1.1% move. I've been watching the VIX remain Bostic all day, 21.03. Yeah. That's a constructive number over the last 48 hours.
It's a constructive number, and you haven't seen the VIX actually settle above 20 for 4 straight days like this for quite some time here. But you look at the market here, you look at equity markets, they still are persistently higher here, recouping most of the losses that we had over the previous few days. Of course, we're going going to count you down to the close in just a minute. We're going to have Brett Schutte at Northwestern Mutual. But what I think a lot of people really want to focus on, Tom, is really that move that we did see with regards to the yield curve. The flattening there, it was subtle, but it's certainly significant.
Very good. Romaine Bostic, thank you so much. Kaylee, we're going to drive forward the conversation. I believe Abramowitz parachutes in tomorrow. Lisa Abramowitz will join us in the morning. And what we're going to do there off Michael Feroli and what we saw on the state of our potential GDP, which is a horrific and frightening number by JP Morgan, is the idea of the American labor economy. Of course, we heard Chairman Powell speak of that, the mysteries of it right now. Joining us tomorrow, David Blanchflower of Dartmouth College, truly the nation's expert on wage dynamics. It'll be really important to speak to the former Bank of England member. Kaylee, one final thought from you. Go.
I think it's all about that flatter curve for me. But as Jeff Rosenberg said, you kind of have to squint to see it. Yeah. All said, given that we did get confirmation from the Fed that a November taper announcement is looking likely, you would expect more of an outsized market reaction than we're actually getting. Yeah. Absolutely historic press conference today to see him on the prepared statements talk about the presidents of the Fed. That'll be a big discussion tomorrow. We drive forward. The close is next. This is Bloomberg. Good morning.
The boosters work, and they will definitely help. The boosters, both the Moderna and the Pfizer booster, take antibodies back up to at least where they were, and probably twice or 4 times where they were at the peak. It's definitely teaching your immune system to recognize Delta better. The antibodies that people are making after a booster, they are better antibodies. And they're also probably then better antibodies at recognizing other variants in the future. If you get infected once, your immune system says, all right, here's how much I want to set aside of memory, right, to not get that again. You get infected twice, your immune system says, well, that didn't work, right? It should probably up that some. You get infected 3 times, it's like, all right, this is a problem. It's really worth not getting sick anymore. And so the vaccines are essentially that, right? And if the immune memory was pretty good after the second one, what's probably going to happen after the third one is that it's going to be more stable. Even if the peak is the same, you're going to keep more of it for a longer period of time. It's a race, right? It's a race between the virus and your immune system.
whilst there is virus circulating in the unvaccinated world, there are huge risks of variants emerging that will eventually be able to beat the vaccines that we're using in the UK, in the US, and in Europe.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Countdown to the Close. I'm Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostick.
He's still on. Meanwhile, let's have a look at what's happening in terms of your markets, because we bounced back. Yeah. We bounced back fine. This is in lockstep, really, but your outperformer, as always on days such as this, the Russell 2000 in the white, really managing to take lift off vis-a-vis some of the other key performers. But the NASDAQ, the tech, just underperforming somewhat, but this is your futures market. But this is how we continue to power higher. The Federal Reserve manages to get away without a tantrum. Stocks push higher, even though we lay out how the tapering will occur.
Well, without a tantrum for now. We'll see what happens in a few months. I mean, right now, you got a lot of folks in the equity market sort of getting boxed in. You got nowhere else to go here. I mean, look, he pretty much telegraphed what they want to do, at least. Whether or not the economy cooperates remains to be seen. Right now, people seem to be buying it based on some of the bids you're seeing to the bank stocks, KBW Bank Index, up about 2%. You're seeing the big cat tech stocks also get a bid here on the day, sans Facebook, which is down for completely other reasons that I don't think had anything to do with Jay Powell. He didn't mention Facebook during there. I don't know. He mentioned a lot of other things, including muni bonds. We'll get to that shortly, I'm sure. Oil stock's been on fire here. Of course, we actually saw that bid come in even before the Fed meeting took place and before Jay Powell started speaking. But again, a lot of bets here on sustained economic growth here, relatively modest inflation here, a labor market that's still healthy, and maybe some sort of normalization of rates is done in a manner, I guess, that is, to the liking of the markets. Taylor, you tell me.
Let's ask Brent Schutte.
Yeah,
he might know the
him.
answer of that. Chief Investment Strategist for Northwestern Wealth Management Company, of course, where he oversees more than $225 billion in retail assets. So, Brent, answer the question. Did this strike the right tone for the equity markets, up 1%, and a bond market that is rallying 2 to 3 basis points down on the day?
I think so. And I think if you pull it back and take a look at it, to me, there were some changes around the edges, but overall, the message to me is still very much measured and patient, with erring on the side of too much, not too little. And so if you think about it, we're still talking about 3 potential rate hikes per year. And in 2024, the end rate is supposed to be 1.75%. That's well below their long-term neutral rate of 2.5, which means the economic cycle they believe will still be going then. And so to me, I think it was a balanced press conference. I think the market was worried about hawkishness because of all this talk about inflation that is dominating the headlines these days. But all in all, I think the Fed is still who we thought they were, and they're still going to err on the side of doing too much. And that is still market friendly in today's environment.
Market friendly, but who are the outperformers and who are going to be the losers? How much can we still bet on a reopening cyclical trade that seems to run out of steam when we worry about the Delta variant?
Well, I think you've had a myriad of worries the past few months, and I think they've all kind of bled into the market, and they initially caused more people to go defensive. But over the past few days, we've seen a little bit more of a selling off. And so if you think about those worries that we've discussed before, all those really started in mid-May. So you have the too much camp that's worried about inflation and what will the Fed do? We kind of had that question answered today. You have the too little camp. That includes China and COVID. And so right now, everyone's looking to see if COVID cases roll over. This week, you had China come back in the news because those debt payments from Evergrande were due. And then you have the fiscal policy camp that is worried about what's going to happen there. You have the continuing resolution, you have the debt reconciliation, that's coming to a head. I do think as this all pulls back, as the market gets more certainty about what is actually going to occur, you are still going to see strong economic growth. The consumer is in fantastic shape. Corporations are in good shape. And I still think that means that you have one last gasp potentially in that cyclical trade, in that value trade, which quite frankly, if you look at small caps, they're as cheap as they have been versus large caps since 1999.
Yeah, and obviously that's playing out at least on a daily basis here, of course, with the Russell 2000 outperforming, Brent. Of course, a lot of people seeing maybe a potential reignitement of that cyclical trade. I guess the question here, Brent, is when does that fire actually start to burn out? Do we start to see that burn out once we get 6-10 months out, when that taper maybe potentially is at towards the end and a lot of people start thinking about rate hikes?
Yeah, and so I do think it does start burning out or fizzling just a bit. And I think the strong part of that trade is probably done. We saw a really strong trade from, I believe, around August till May of this year. that was incredibly strong. That made up a lot of the ground, but there is still more to go. And I think it's been this, you want to own growth and defensive versus you want to own small cap or cyclicals. I think it's more of a balanced future as we get past this next, I think, bout of what I think small caps will outperform. I think you get more towards a balanced trade. And then typically large cap and defensive doesn't do all that well relatively until you start worrying about the end of the cycle. And we're not there yet.
We're not there yet in terms of the end of the cycle, but what are we worrying about as to, well, when we might indeed see oil, energy, commodities feed into this, Brent?
Yeah, I mean, I think the biggest question and the biggest risk that I think is out there is still inflation. And that's why I think people should try to hedge against it. And I think you hedge against it because the Fed's not going to quell it until they actually have to. And so in the past, if you were an investor, if you thought inflation was going to rise, you bought longer term treasuries, you prepared more defensively. I think the Fed is showing you that they're willing to wait until they actually have enough evidence that it's here and it's staying. And so that to me is still the biggest risk. I'm not suggesting there isn't a risk of a downside, but if you think about what has happened with the policymakers around the globe, they are trying to cover the downside risk. They're always and everywhere willing to do more. They will do that until there's a cost on their side. That cost has to be an interest rate spike, a dollar fall, or an inflation rise. And we're not there yet.
Brian, can you tell us if the taper tantrum is behind us this time around, given how well choreographed it seems to be this time?
Yeah, that's a good question, and I don't know if I have the perfect answer. I think it is right now, as long as the inflation data shows that it comes back within. If it doesn't, then I think maybe we don't call it a taper tantrum. I don't know what we call it. Maybe it gets a new name in the cycle. But I do think that's what people are waiting for. That's the one that's still outstanding. Right now, it seems to me as if they're one-time price hikes. We'll see. I mean, I think a prior guest on your show brought up wages and the labor market. Will people come back? That's a big question that weighs into that inflation commentary.
All right, I mean, just want to go back, though, I mean, with regards to the taper tantrum and your previous response, Brent, I mean, you made a great point here about how the Fed may react, or at least how it will try to react to sort of keep a floor under things here. I guess, do we ever get to a point where the market does really try to test the Fed and throw that proverbial tantrum here? If that does happen here, what's the Fed's option?
Good question. I mean, to me, maybe they have to tighten at some point. That's the one thing that I think is maybe different in this cycle. I mean, I don't think we've had a 50 basis point increase in the federal funds rate since 2000 or something like that.
Yeah.
So it's been more patient and deliberate. This cycle, to me, could end a lot. I still think it has room to run. I think there's still a productivity story that has to play out that keeps inflation at bay for a while after we get past this transitory inflation.
Yeah.
But the Federal Reserve used to try to moderate the business cycle. That stretched it out. Now they're saying we're going to wait until the end and be more reactive. That could mean a more damaging end of the cycle, and it could happen more abruptly. But I still think that's a 2024 story, not a 2021, 2022 story.
Still time to buy them, Brent Schutte. We thank you, Chief Investor Strategist for Northwestern Mutual Wealth Management. Always great to have his voice on the show.
Yeah.
Thank you.
Yeah, absolutely. Brent's always great, and he makes some fantastic points here about how the Fed may actually react going forward. Taylor, you got something to say? Are you listening?
I'm listening.
Yeah.
I'm laughing because you seem interested and disturbed at what he's saying. I like your facial reaction.
Look, all right, we're moving closer to the bell here. This is why I'm agitated, because we're about to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. An agitated Romaine Bostick, Caroline Hyde, and Taylor Riggs silent right now. Counting you down to the closing bell. Here to help take us beyond the bell, Carol Massar, Tim Stenovec, bringing the heat, bringing together our Bloomberg television, radio, and YouTube audiences on this Fed day.
Why are you agitated? Why are you agitated?
I just got off the set with like 2 hours with Tom.
I know, because you're a star. We need you all over the place. By the way,
I was glued to the coverage, Romaine.
Yeah, it was fantastic.
I didn't know you grew up near Peoria either.
I grew up in Chicago. I sort of fibbed a little bit.
All right. Oh, okay. Well, that's okay.
Never let the truth get in the way of a good story, Carol.
I know. Exactly. Good point there. Did we get what we thought would happen? I feel like we got a little bit more clarity, you guys.
Market likes what it's got. Certainly rallying higher. No taper tantrum here, Tay.
Yeah, certainly not. And Brent Schutte, of course, making some really good comments. He spoke with us on TV, of course, Tim, before we joined you. And you're seeing bonds rally. That's yields lower by 2 to 3 to 4 now basis points across the curve.
Yeah.
Really pricing in what could be a well-behaved bond market on a lot of disclosure and a lot of, telegraphing.
Were you really taken by the
this.
bond market reaction? Because everyone keeps talking about this massive flattening here. And I guess it's significant.
Well,
Yeah,
I
Tim,
was
you have
interested to
something
hear
to
what
say.
Jeffrey Rosenberg said. He said you've got to squint to see that market reaction. I know you pushed back a little bit on that, Romaine, but if you look at the equity market reaction, at least, it looks like, Romaine, we're going to finish right where we started at 2 p.m. Wall Street time.
Yeah.
When we started to hear from the Fed.
You got to
that's
squint a lot.
Yeah, well, that's a good point, Tim. I mean, we're actually pulling back here. We're well off the highs of the day here. We were up around 44.16 on the S&P 500. We're back down below that right now at the point. And just to your point, Tim, when you talk about when that Fed announcement came here, of course, the market spiked up to the highs of the day. It hasn't seen that basically since 2 o'clock. Once Jay Powell started speaking, you got a little bit more traction, but then that started to fade here as we got to the closing bell. Still, it's going to be an up day. People cheering, people clapping. S&P 500, 41 points up higher on the day. That's almost a percentage point. Dow Jones Industrial Average, if you still believe in that, that's also up 1% on the day, as is the NASDAQ Composite, 150 points. Hey, look, I mean, we were just talking to Brent Schutte at Northwestern Mutual. Look at the Russell 2000 here. He talked about this sort of potentially reigniting that cyclical trade and putting some faith back into that. You saw the Russell 2000 outperform here on the day, 1.5%. This is one day, guys. What happens tomorrow? What happens over the next 3 weeks? What happens over the next 6 months?
Romaine, was that a double shot of espresso in your coffee?
I haven't had anything all day.
All right. So listen, the KBW index, bank index, was something I was watching because we did see a pop higher following the Fed decision. Even as we saw the longer end of the yield curve as it moved up, that maybe is promising certainly to the financials who are looking for rates to go higher, all about net interest margin, looking to make more money. They did end up about 2% though on the day, Taylor.
Yeah, Carolyn, really interesting when we take a look at the macro and take a look at some of the individual sectors that we're looking at. I'm going to show you something, and for the radio audience, I will tell you something that we haven't seen in a really long time. And this is a lot of green, even in the losers section, as we're really trying to come off of a rebound and a well-behaved press conference, if you will. For the radio audience, it's the winners, it's the losers, it's energies, it's banks, it's semiconductors, it's autos. How much of that, more than 2 to almost 3%, is that reflationary, inflationary trade that is underway? We migrate you down to the bottom, to the losers. There isn't a lot. There's only 4 sectors, but it looks pretty defensive. It's food and staples, it's utilities, it's transportation that's off anywhere from 1/10 to 1/7 of 1%. So, Carol, overall, you really could categorize this as pretty risk on.
Yeah, absolutely. A lot of green on the screen really tells you what investors thought about this Fed meeting and that Fed decision. Speaking of gainers in today's session, this was a decliner yesterday. Walt Disney Company bouncing back a little bit from that 4.2% decline yesterday.
I love how formal you are with that Walt Disney Company. Isn't it just Disney?
I'm a formal kind of gal.
Okay. Go ahead.
Okay. So the Walt Disney Company up 1.4% in today's session. Basically, a bunch of analysts coming out and saying the sell-off yesterday, we lost about $14 billion worth of Disney market value yesterday, saying it was overdone. So you had the street really weighing in. The street does love this stock, by the way. 29 buys, 6 holds, no sells. All right, let's also talk about Netflix today.
Willy Wonka.
Willy Wonka and Matilda meeting Bridgerton and meeting The Crown, because we had Netflix agreeing to buy the works of the well-known novelist Roald Dahl. So it was a big catalog. It's all about content, we know, for the streamers.
Are they going to remake Charlie and the Chocolate Factory, you think?
James and the Giants.
Remake it again?
That's going to be my favorite.
How many times has it been remade?
I don't know. I mean, there's only one as far as I'm concerned, the Gene Wilder.
The original. I know. All right, so Netflix up 3%. Stitch Fix, I wanted to hear more about Caroline and where she's getting her clothes because I find that fascinating. Rallying big time. We broke the earnings down after the close yesterday. That stock up 15.
Stitch Fix, this is where they just send you a box of clothes?
Yeah, I guess. I don't know. Do you use this one, Caroline?
They style you.
Very stylized version,
Yes.
though. I don't use Stitch Fix.
I don't either. I was looking at it.
Full
though.
disclosure.
Okay. Anyway, better than feared quarter is how people are.
You know, there were 2 IPOs today that kind of got lost in the mix today. You had Toast, which was finished up 56%.
Right?
And of course, Freshworks, the software company, was up 32%.
You are on a tear, man.
Money in restaurants.
Whoa.
All right, enough talk of up. I want to talk a little bit about
All right,
down.
let's see what
because
Tim's gonna
even
bring
though
us
there was a
down.
lot of green today, no shortage of stocks moving lower, especially some interesting stories playing out. FedEx, we broke the earnings down yesterday. Look at that, finishing the day down more than 9%. We're going to talk about labor when it comes to what Fed Chair Jay Powell said, but this is a labor story. The company cut its profit outlook for the year as a result of labor shortage driving up costs. They're actually turning away packages from customers to help keep service from deteriorating.
And Tim, I know we're going to talk about this later, but this is a big issue, and it's not just
Huge.
FedEx. I mean, so many. I mean, wasn't there a headline just a little while ago about Apple giving bonuses? Yeah.
Yeah, I mean, look, $1,000 going to get people off the sidelines and into the Apple store physically if they're worried about.
Need more people in childcare, team. Need more people in childcare.
That is absolutely right, and that's something that Fed Chair Powell said during the press conference.
Yeah.
That is, and it's a global issue too. It's not just one here in the U.S. We'll get to that in just a second. I do want to hit on Facebook. Shares closing lower by 4% at a 2-month low right now. This is a story about Apple, the company putting out a blog post, interestingly enough, in the Facebook for small business category, because small businesses do power Facebook's revenue, warning that the new rules that require app users, I should say, or Apple users to that they're willing to allow their activity to be followed across the internet. They actually have to opt into that. We knew that was going to happen, but Facebook's saying that it's going to affect the company more than previously thought. Also keeping an eye on Workhorse, shares plunging to the lowest level in months after the EV company, Caroline, said it would suspend deliveries of its vans. This is the C1000. The company has recalled 41 of these vehicles that have been delivered. They do say that they expect to complete the testing that is necessary in order to certify them under federal motor vehicle safety standards in this fourth quarter.
You're on the downside. I looked to the upside, and it was a story when we saw it from industry groups, as Taylor was talking us through. Oil and gas on a tear today. I go cross-asset, I look at commodities, and today wasn't just a story of the Federal Reserve, it was a story of China, a story of Evergrande, a story of a dialing back of worries about China. So it's interesting that we saw metals on a tear, steel up more than 1.8%, iron ore on the higher side. We saw copper bounce significantly, but oil, Brent crude up more than 2%. We're at $75.93. Why? Well, limited supply. We've got a much tighter market than many had expected. The EIA coming out with its numbers, and look, there's still more pullback in terms of the US inventory levels than we'd had anticipated. Oil pushes higher. What does that mean? It means in FX that the Canadian dollar is up 0.4% against the US dollar. It's basically the only thing that's trading higher against the US dollar. US dollar stronger after the Federal Reserve, a more hawkish Federal Reserve, talking, of course, of tapering. Yen off by 0.5%. We're not seeing that search for safety as much as we had done in the last couple of days that had helped the Swissy and the Japanese yen. Japanese yen off by 0.5%, the euro off by 0.3%. And a mixed picture when you're looking at sovereign bonds, but what steals the show is US bonds today. Taylor, take us through it.
Yeah, indeed. And of course, as Romaine's been mentioning, the highlight has been the flattening of that yield curve. We look quickly, as we always do, at the 2-year yield. We're up on yield 2 basis points now to about 24 basis points, maybe showing that we've pulled forward some of those rate hike expectations. But it's further out on the curve on the 10s and the 30s that you're down 2 and 4 basis points. But again, pretty much range bound at a 130 and a 182 when you're looking further out. If we bring forward some of those expectations and indeed start discussing in real terms that taper, does that mean lower inflation and lower growth potentially further out on the horizon? Carol, what might be the bond markets are signaling?
Exactly. Listen, we've all been looking for more clarity, more specificity when it comes to Fed policy. And I think it's safe to say that we got some of that. Check out what Jay Powell had to say today in his press conference.
The committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. Since then, the economy has made progress toward these goals. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted.
Kind of like an Andy Cohen drinking game, because we heard Jay Powell say progress 3 times, and I feel like that was
with alcohol with her.
No, it's not. But I mean, this is what he's saying. We're making progress in some of our goals, whether it has with labor, although he talked about it being a very tight labor market. And I have to say, he continues to leave the door open, though, that things could change.
Well, I thought his language here on the labor market was interesting here, because he talked about sort of what he needs to see. I think he was asked specifically about what he needs to see out of the next a few jobs reports here. He basically said he wasn't necessarily looking for a knockout jobs report in his words, and that anything that was, I think it was reasonably decent or something, I think was the exact quote here, might actually be enough to move the needle to that substantial further progress. I thought that it sounded pretty hawkish to me. It seemed like the bar is a lot lower for them to meet that labor target than maybe what's being priced into this market.
I was struck by that too, Romaine, especially given what we saw in August. And